We're in this brave new world where we have more political, geopolitical risk, more fiscal, higher inflation, higher rates.
By virtue of having inflation, you eventually slow down and reduce the real balances, and the consumer feels squeezed.
There's still a lot of excess buffers in financial markets and among households.
Ultimately, it's a question whether the Fed takes the high road or the low road, proverbially and literally with rates.
If we do get to a 6% rate and have to hold at 6%, I think we're increasing the probability of a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from a beautiful New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures just about positive on the S&P 500. TK looking ahead to payrolls and Chairman Powell, a defining week for this market.
Single best line of the weekend, Michael Darter writing at Roth MKM. He says the Fed is in an awkward position. I thought that really captured the clumsiness of the moment. And this morning, the awkward position is defined by a spread out to a new record-wide negative 92 basis points as we speak, signals the week ahead.
New growth target out of China over the weekend. It has a 5 handle, but it's just 5%. Now, I made the point yesterday, Brammer, I think arguably that's maybe the best news that Chairman Powell and President Lagarde have had all year, maybe in the last month for sure.
On one hand, this is perhaps disappointing to people who are on this global recovery fueled by an incredible boom in China. On the other hand, this really reduces some of the potential inflationary pressures coming from China if it's just 5%. And, oh yeah, by the way, positioned perhaps to go lower going forward.
Looking forward to catching up with Endocoin a little bit later. Need to catch up with Credit Suisse as well. This stock right here, David Harrow, David Harrow of Harris Associates saying this to the Financial Times: why go for something that is burning capital when the rest of the sector is now generating it? Eurozone banks year to date up more than 20%. This one right here, negative on the year. Tom, Harrow exiting that stake at Credit Suisse.
This is a storied career. Full disclosure, I'm a good acquaintance of Mr. Harrow's, but David has earned acclaim in international blue chip investment, and he's gone down in flames over a long duration with this holding.
I also wonder if this is going to be not the straw that breaks the camel's back, but this is such a long-standing backer of a company that now is getting so much Middle East money. Does that really lead to a question of where the leadership, where the ownership, where the influence is going to come from?
Ultimately, the problem David had, looking around Europe at the moment and Eurozone banks, European banks are performing really well. And not just in the Eurozone. Look to the other Swiss banks. UBS is up 20% year to date. Why would you watch all of that happening and stay in this, Tom, with trouble after trouble, quarter after quarter?
Yes, but that conversation could have been had 8 years ago, 6 years
That's
ago,
a good point.
10 years ago, whatever. The outperformance is there. And let's, again, remember, you're capturing a ginormous dividend while you waited for the European banks to finally move.
Credit Suisse right now down by 1.6%. Just to whip through the price action for you. Squeezed out a week of gains on the S&P 500 last week. Can we add to it? Futures, let's call it unchanged on the S&P. Pulling back from the highs we printed last week, 4% plus on the US 10-year, back down by another 4 basis points on a 10-year at the moment, 391.27, and euro dollar, Lisa, just about negative here by 0.1%, euro dollar 106.27.
This week is going to be an important week, and I really wanted to set it up to give you a sense of all the different facets that are going to be going on and playing here in markets. Central banks are looking at a full week with Fed Chair Jay Powell testifying on Capitol Hill to the Senate and the House on Tuesday and Wednesday, respectively. On Wednesday, you get the Bank of Canada meeting. They've been actually talking about possibly moving against the grain and not raising as quickly as people had previously been expecting. Do they continue that? And what are they signaling with the whole transitory or perhaps higher and hotter inflation? And then on Friday, this is going to be interesting. Haruki Kuroda, the governor of the Bank of Japan, this is his last Bank of Japan meeting. Does he deliver a surprise? Meanwhile, on the government front, President Biden will be releasing his budget for fiscal year 2024 on Thursday. This is going to be really important to get a sense of what his goals are, what he could potentially get accomplished, and then how that dovetails into the war in Germany. Well, he will be hosting European Commission President Ursula von der Leyen on Friday. And then, of course, on the data front, you get JOLTS, the job openings report on Wednesday, and the U.S. February jobs report on Friday. That's going to be really key, John, especially with a data-dependent Fed. We all know that the February jobs report completely changed the narrative. If we get some sort of feeling that wasn't a one-off, how much does that increase the rate hiking expectations in markets?
And what's so important here, John, buried in the week's data is the household change in net worth. This is not a small item. It's the oddest America right now. So many people struggling. The inflation's tangible. We start the week with a VIX at 19.06. House prices won't come down. I believe we've observed that. It's a generalization. I really wonder what the state of the wealth of the haves is going to be.
I'm told we've missed a story. Manchester United. Do you want to squeeze that in? I wanted to make today a safe place for Manchester United fans after the result over the weekend.
I think they're vulnerable.
Should we stick with that? Just a safe place. Make it a safe place for them.
Okay.
Just a place that they can come to, a sanctuary, if you will.
Who are you?
And avoid the football score over the weekend.
What happened to you this weekend?
I turned it on. We're all Formula One, and we're honored that Christian Horner will join us here later. And John, I turned it on. It was 0-0. It was a good match. I turned it off. Boom.
Came back in the second half and bang. It's a safe place, a sanctuary here on Bloomberg Surveillance for Manchester United fans. Laurie Calvasina joins us now, head of US equity strategy at RBC Capital Markets. Laurie, I want to start with a line from a peer of yours, Stuart Kaiser over at Citi. He said, we remain in the camp that good growth is good for stocks. Laurie, is good growth good for stocks?
Well, look, I think that it depends on exactly when it comes. I think that markets are trying to sort of, frankly, start ignoring 2023. I think people are ready to get past it. And if you look to 2024, valuations look reasonable. So I think investors do want a sense that even if we get a little bit of a recession here, it's not going to be that bad. But I think we're increasingly getting closer to that point where investors want to make the case that we can start to play the recovery in 2024. So I think I'd probably agree with Stuart on that.
If we have inflation extend, Laurie, what does it do to revenues? What does it do to nominal GDP and to revenues? To me, that's the heart of the stability and even the lift that we see in equities.
It's a great question, Tom. And, I think inflation is complicated when it comes to the U.S. equity market outlook. In my modeling, what I find is that CPI actually has a higher correlation with S&P 500 revenues than GDP. So we know that if inflation stays a little bit elevated, it's going to boost those revenue numbers. There are, however, knock-on effects potentially on margins, but there is also another complicating factor there with pricing power as well. So, if you want to keep your pricing power, you need to keep a little bit of inflation. But I think where the big offset is on the valuation multiple. So if we have higher inflation, it keeps your revenues elevated, but it depresses your multiple.
It depresses the multiple, but then what do multiples do through the year? If we're vigilant, if we're stable, dare I say we even appreciate in value, how does the classic price to earnings or price to free cash flow multiple move?
So we've done some work, and I would say it's somewhat controversial. I don't know why it's so controversial because it's just math. But if you go back to the 60s, and we have some good data looking at PE multiples going back to the 60s, and we've built a little model that says if you plug in X, Y, and Z on inflation and interest rates, here's what your PE should be at the end of the year on a trailing 4Q basis. And we look at inflation rates, we look at 10-year yields, and we look at Fed funds. And if we bring inflation down to about 3% using PCE and core PCE, have something, say, around 3.5% on the 10-year Treasury yield, which is still where the ECFC forecast is on Bloomberg. And I think we baked in recently 5.05 on Fed funds. So, having, optimism for a little bit of easing in the, final part of the year at least, but still pretty high relative to where expectations were. We think you can get above a 21 times multiple, which should give us, some lift in equity prices this year. And when we do the math, we basically come up with the idea that you could even be above our 4,100 price target, say in the 4,300, 4,400 range. I don't know why this is so controversial. It's something I feel like I've been talking about since last summer at length, nonstop. But that's simply what the math shows. We just need a little bit of moderation in inflation, a little bit of easing on the 10-year, and the model's much more sensitive to those than it is the Fed funds rate itself, which is what I think probably really blows people's minds.
It's controversial because people think that something has to happen in the economy that has to play out in equity valuations in order for inflation to get down to that level. Are you saying that that's not true, that you're seeing this sort of disinflationary forces from the corporate earnings, from economic signals that give you confidence that you're right, that we could see ongoing momentum in some of these earnings without huge layoffs and just sort of a natural disinflationary process?
Well, what's funny, Lisa, is that when we bake in the earnings number here, we've got about 199. And so we're actually pretty far below the consensus. And we may actually end up being a little bit too cautious on our number, but our 199 number is baking in that moderation in inflation, which is depressing revenues. and is baking in, not a fantastic economy, but not necessarily a terrible one either. So we think we've got, sort of the right call here. And our numbers may be off a little bit here and there, but the idea that the economy can get hit, not too badly, but get hit in line with the consensus expectations, and inflation and rates, can stay above, kind of where they've been, but just come in a little bit and continue that path to coming down. We think that, and of course, sort of bake in a higher Fed rate. We think that it's enough. And I think what really confounds some of my peers is they think that multiples didn't fall enough to begin with. And we actually completely disagree with this, because if you look at where the markets were at the October lows last year, it's where my model, pretty close to where my model said you should have ended up at the end of last year based on the 222 earnings. So I think that's a key difference, is we think multiples already fell enough, and it's time that we can start seeing some of that recovery, as opposed to a lot of people who think we still didn't see a trough multiple yet. And I think that's a big difference.
Laurie, just the perfect guest to kick off the trading week. Thanks for being with us. Laurie Calvasina there of RBC Capital Markets. Looking ahead to Chairman Powell, 2 days to testimony on Capitol Hill, going into payrolls on Friday. Lisa's asked the question Tom has, I have, we all have. Will the February data confirm the boom of January? Mislav Matejka over at JP Morgan with this to say to kick off the week. Our core view is that the current activity upswing is unlikely to develop into a fully fledged acceleration in the second half. For that reason, Tom, ultimately, they advise their clients to use the Q1 strength in order to reduce exposure.
These are the opinions that are out there. I saw about 14 opinions this week, and from 13 notes.
Saw 10 alone this morning.
The one John Stolfus just published moments ago, and the one word I'm seeing on Monday set up by the bulls is not so much bullish optimism, et cetera, but this word resilient. And you can afford to be resilient if you sustain inflation and sustain nominal GDP. It helps out. It may not be constructive, but it helps out.
Speaking of the bulls, should we talk about Red Bull? Coming up in about, 20 minutes from now, Christian Horner, the team principal of Red Bull Racing in Formula One, TK dominance over the weekend from that team to kick off the season.
Because I'm the dumbest guy in the room, and Mr. Ferro, who grew up next door to Horner, will lead the interview. All I can say, John, is we've never seen this, where sport and entertainment, film, have combined. Ever have we seen this.
And this sport finally breaking the United States of America in a major way.
Children have wonderful table manners. It's just extraordinary.
How have we pivoted to that?
He and Mrs. Horner have just beaten the children.
Is that a flavour of the interview still to come in 20 minutes?
That's my lead
can't
question.
Wait. Great tease. Christian Horner of Red Bull. Coming up, we hope.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China has set a modest growth target, suggesting that there will be less of a boost to an ailing world economy. Beijing's goal for gross domestic product growth this year is around 5%. Economists had expected a more ambitious target following a rebound in consumer spending and industrial output. U.S. lawmakers are stepping up the push to ban TikTok. Senate Intelligence Committee Chairman Mark Warner plans to introduce a bill this week to allow the U.S. to systematically ban Chinese technology, including ByteDance's popular video service. One of the concerns is that TikTok gives China access to Americans' data. A second Norfolk Southern train derailment in Ohio has Congress calling for rail safety legislation. Saturday's derailment happened outside Springfield, Ohio. Now, that's about 180 miles west of East Palestine, where a derailment spilled toxic chemicals last month. The CEO of Norfolk Southern will be questioned on Thursday when he testifies before a Senate committee. Now, negotiators have agreed on the wording of a landmark United Nations treaty designed to protect marine life in the ocean. If it's ratified, the treaty could build in new hurdles for corporations on the high seas. It does not regulate overfishing, which is managed by other organizations. And Credit Suisse has lost one of its biggest backers. Harris Associates stock picker David Harrow has sold the firm's entire stake in the embattled Swiss bank. Harris Associates was the biggest shareholder in Credit Suisse for many years, but by the end of last year, it held only a 5% stake. Shares of Credit Suisse had a record low last week. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The growth may be pretty respectable. I think 5% is pretty good coming out of COVID. and it'd still be something of a growth engine for the global economy. But a knee-jerk reaction that they're going to go back and buy a ton of commodities, I think, is probably not right, and the markets are guessing that that's probably true.
Fantastic to hear from Michael Spence, the General Atlantic Spencer advisor on China's growth. A whole lot more than that. TK, I think you'd lead with the fact that he was a Nobel laureate, wouldn't you, Mr. Spence?
Spence is extraordinary. He reinvented graduate education in America. What he did at Stanford years ago now is just taken for granted. But he was the first to restructure a master's degree in America to value.
Very cool.
Nobody talks about
and fantastic in the last hour to hear him talk about that new growth target out of China. Has a 5 handle, but that's where it ends.
Terrible.
It's 5%. And it's been described, and I say that this word should be in quotations, as disappointing. We'll see if it is disappointing. 5%. Is 5% disappointing to you, Lisa? 5% growth in China?
Some people are talking about the potential for a 6 or 7% increase just because of the sort of reopening trade. The question is this the high point? Is it only going lower from here? And what does it imply about the fiscal policies in China if it means that they're not necessarily going to prioritize hot growth?
I'm with you. That's the interesting piece of it. Another interesting piece of all of this, kind of below the radar, beneath the radar this morning, this reporting from the team here at Bloomberg. The Biden administration is nearing completion of an executive order that would restrict investments by US companies in parts of the Chinese economy. A focused here on China tech. Tom, maybe look out for some headlines associated with that story a little bit later.
Yeah, the China tech issue is very tangible. It's very, very real. But, I love Ben Emmons had a quote earlier this morning. You know what? We're in love with our consumer products from China. And that's the end of it. What does the administration do? What do the Republicans and Democrats do to limit the stuff we love from China? The answer is they're not going to go there.
U.S. lawmakers are right now working on a bill to ban TikTok, and they're going to roll it out this week, and it's bipartisan.
That's not what I was thinking of. I was thinking of like cell phones and
I don't think the iPhone's
stuff.
a part of this. This is stuff that helps China's military and intelligence capabilities.
This is very
now, whether
serious.
you would fold TikTok into that bracket,
the fact that
some people might.
The fact that they're examining every aspect. There was a story about cranes being built by China.
I saw that.
And the concern that could have secret spy equipment in there. I mean, China's saying that the U.S. is just paranoid at this point, but the fact that people are even examining this gives you a sense of the scope.
That sounds kind of paranoid, doesn't it, when you start thinking about cranes? And I've got no idea. Just when you start going there, it just sounds a little bit paranoid.
When I say that, it definitely does. But also, if we were talking about spy balloons, it also would sound a little bit paranoid.
But that's happening.
Oh, no, we're beyond spy balloons.
What are we on to now?
We're on to the mystery of 5%. Is that good or bad or whatever it is? Let's get some expert opinion on this. Enda Curran is encyclopedic on this. He's our chief Asia economics correspondent. And I want to go to the age-old solution, which is every cycle of China from 10 down to 8. We got to get back to 10. From 8 down to 6. We got to get back to 8 and on. They bail out the property sector. Over the weekend, did our Bloomberg News team discover that once again they're bailing out the property sector?
Well, there was some messaging in there about extra support for the property sector. Tom, there's no doubt that's underway, but the big takeaway was this 5% growth target. Disappointed Wall Street because most analysts had come in around the 5.5% area. There seems to be some managing of expectations going on here by Beijing. They don't want the world to think they're going to go away again and unleash a major kind of a debt-backed borrowing binge like they did in the past decade.
And it's so important here, in all of your work here, and frankly Steve Engel's work and the team, can we parse 0.5 percentage point of guesstimate on China GDP? I would suggest that's foolish.
Well, I think the way a lot of people are looking at this, Tom, is that 5% is going to be a floor for China's economy, right? It's a target that they should hit pretty easily because of the pent-up demand post-COVID zero. Consumer sentiment's better. Business sentiment is better. We're already seeing that in the data. So 5% should be easy to hit. The second half of the year might be harder, and that's where, of course, the government will kick in with spending. But whether or not hitting how high it goes beyond 5%, or whether it's 5.5% or higher, I suppose, that's where you get into a very academic debate then about what its net contribution will be to global growth.
And there's always been this tension, at least from outside analysts, about where the priority lies in China. Is it growth, as it was for decades, or is it some of the social and governance aims of Xi Jinping, including the data oversight, including trying to increase certain types of production in China and making more investments on that level. Is the 5% goal, or the 5% expectation in growth, a sign that the other aspects, the non-economic aspects, could take a high priority in the upcoming year?
I think tackling inequality has been a priority for Xi Jinping. I mean, it has been for previous administrations too. Common prosperity has been mentioned in past Chinese party documents. But no doubt, absolutely, Lisa, that side of the ledger is on his agenda. We had some comments from President Xi Jinping today, to your point. He was arguing that protecting the rice bowl has always been among his top priorities. But he also said, as has been driving manufacturing development in China, forceful changes. He wants to push China to that next level of manufacturing development. I think that's where it's going to get very interesting over the years ahead. How can China pull that off? In the go-go years, they could attract capital and people from Europe and the US in the blink of an eye. But now you have these export restrictions coming on from the US, what seems like every other week or so. I think it's going to be very interesting to see if Xi Jinping can pull off that development agenda, which of course feeds through to what he can do for the broader standards of living for the rest of the population too.
What kind of retaliation do you expect from China, from Xi Jinping, to some of these measures by the U.S.?
It's difficult to say what they can do, really. I mean, we've had obviously the ongoing barbed rhetoric against the US, but it's hard to say if they can have the same. They can't strike back and hurt US firms in the same way that US can hurt Chinese development on these kind of issue. But it shows you how things have changed. And only a few months ago, we were talking about Janet Yellen heading to Beijing for talks that was supposed to get the economic relationship at least on a stable footing. Then, of course, we were expected to have the Secretary of State Blinken visit. That was supposed to get the political side of things back on track. But none of that's happening. And here we are now talking about export controls and whether or not China can retaliate.
Enda, thank you, sir. As always, Enda Curran there of Bloomberg on the latest over in Hong Kong, a 5% growth target from China's authorities. Lisa, I think the major bulls, wanted this clean reopening, some fiscal stimulus in the mix, maybe kiss and make up between the United States and China. It's not going in that direction, just not yet.
If it was that, though, to your point, would that really be great for the bulls, right? Because you could potentially get a pop in oil prices and energy prices we just haven't seen yet. So on the flip side, does this reduce some of the inflation that you could see on the margins if there isn't that kind of growth?
I certainly don't think it would be good for the ECB. No. And Christine Lagarde, the ECB president. This is what we're hearing from the chief economist over at the European Central Bank, Philip Lane. Wants more ECB rate hikes, but says policy can't be on autopilot. They're set to go 50 basis points at a meeting this month. It's going to be about whether they guide towards another 50 at the meeting after that. Philip Lane just moments ago, Tom, exactly what the ECB does in May will be very data dependent. And I guess we'll see.
I think we're going to see that across all central banks, including what we see here day after day, or including this morning, I might point out, as well. The data dependency has never been wider because the time is original. We have to, I can't emphasize enough, John, we are still coming out of pandemic debris.
Year 3.
Pandemic dynamics, and to use a normal analysis here is just not appropriate.
Although I will say this, I think the Governing Council at the ECB at the upcoming meeting will debate whether they should provide firm guidance to another 50 basis point hike at the following meeting.
They don't have forward guidance unless they do.
I know. It just makes sense, doesn't it? In the same meeting, they guide you towards the next one. They tell you that there's no
This is important. For those of you in America waking up now, 6:25 a.m., John has lived this in England, and I'm living it on the continent of Europe. Telephone calls about inflation.
Oh,
it's
yeah,
not like America. Plain and simple. It's different.
And the rate pass-through is different too. We've talked about that in the mortgage market. It's so much quicker in the UK.
There's a real question, and Andrew Sheets of Morgan Stanley brought this up over the weekend, about how much of the inflation in Europe is really stemming from and driven from the energy prices. And when you get the year-over-year comps, whether you could see more disinflation than people are currently pricing in. I don't know the answer.
I almost stayed in bed this morning.
Yeah,
the only reason I'm here is because Christian Horner's joining us in 5 minutes' time from Red Bull Racing. That's it, TK.
I won't mention Fernando. I won't mention Fernando.
You should mention Fernando.
No,
what an achievement.
I'll let you.
Very
You'll
cool.
do it with a British accent.
Christian Horner, coming up next. Live from New York, big week ahead for equity markets worldwide with the Federal Reserve Chair Jay Powell on Capitol Hill a little bit later this week, going into payrolls on Friday. Can we build on a week of gains? The biggest weekly gain going back to January on the equity market. On the S&P 500 this morning, futures totally unchanged. On the Nasdaq, a lift by 0.1%. Confronting a bond market with a 4-handle on a 10-year last week, and we did okay, didn't we? We're backed away since then on a 10-year yield right now, 390.88. Yields lower by about 4 basis points. And as the ECB chief economist Philip Lane talks up more rate hikes, your euro, Tom, looks a little something like this, 106.26 on euro dollar.
I think you're right on this to watch currency as we go through the week with all the different data. The 210 spread down to a new record low, negative 93 basis points. I'm not on the 100 basis point watch yet, but boy, we're getting there quickly.
7 years ago, if I tried to talk about Formula One on this programme, Tom would have said,
Snooze.
What are you doing? What are you doing? Wait, Formula what? What's Formula One all about?
Exactly.
Back in 2015, the former F1 boss Bernie Ecclestone had this to say to ESPN. He said, we ought to try to break America, but it's hard for me because I'm not very enthusiastic about the country. It's difficult because they are sort of isolated. They are a big island and they are slowly starting to learn about what other people in the world do. Well, Mr. Ecclestone was wrong. It seems the United States has learned quickly following the sale of Formula One to US-based Liberty Media and with the help of Netflix's Drive to Survive series. Look at the TV audience here, Tom. Average race viewership in the US has gone from about 500,000 back in 2017.
Where was it yesterday?
To 1.2 million last year.
Where was it yesterday?
Probably bigger.
The fifth season.
Probably bigger.
This is a joy now. Christian Horner to join us, and of course, Mr. Ferro will lead this with legit knowledge on Formula One. But all I can say is what is so dominant here, and is it's a safe free zone for Manchester United this morning. Bloomberg Surveillance is a safe free zone for everybody in Formula One that got their clocks cleaned yesterday.
Just ridiculous dominance, Tom. Absolutely. Christian Horner, the team principal of Red Bull Racing F1, joins us right now. Christian, congratulations on the win over the weekend. And let's start there. What goes into it over the winter to turn up in race one and absolutely dominate the way you did?
Well, first of all, thanks very much. I mean, it was a great start for us yesterday. And the regulations, they're constantly being tuned and evolving. But the basis of the car is similar to the 2022 reg. So the team have done a great job in evolving the car and evolving every single detail. Almost every component is new for this year. And with only 3 days of practicing, of testing, it was great to get that first big score in yesterday with a 1-2 finish.
Christian, we've all heard about the rule changes in the last 18 months. It was meant to make it more competitive. And I think a lot of people over the weekend might be looking at the front two and saying, what happened? What is it about this setup, these rule changes, that you think suits you and the team so well?
I think we've only run the cars at this track in Bahrain. We tested there and we raced there, and it certainly suited our car, incredibly well. But, the Formula One calendar is 23 different races, 23 different circuits, different asphalts, different conditions. And the big question is that kind of performance going to carry over into the different variants of circuits that we have? So it's going to take 2 or 3 races. I know a lot of people are saying, Red Bull are going to run away with it. But, we're certainly not thinking like that. And we need to see a few more races to see how things pan out.
Christian, we started this conversation by talking about the changes we've seen in your sport, the attention it now gets from the rest of the world. Can you give us a flavour of that, just how maybe some of the nature and the size of the sponsorship deals have adapted, changed, increased over the last couple of years?
Well, look, we've seen massive growth. I think that the whole phenomenon through Drive to Survive has just introduced Formula One to a whole new audience, a younger audience, and very much an American audience. So I think out of the 25 new partners that we've introduced in the last 3 years, 21 of them are US-based, and 3 of them are in the Fortune 500. It's just, Formula One is on fire at the moment. And what Drive to Survive has done is it's done a great job of explaining the sport and bringing a new fan base in, a young fan base, a female fan base as well, and shown some of the characters and some of the competition that goes on behind the scenes. So it's a bit like, the Kardashians on wheels at times.
Christian, I'm sure that's selling in a big way. Does that work for you, Tom? The Kardashians on wheels?
I can see that.
Is that
right?
what you're
I can
interested?
see that on the side of Max's car. Kardashians
I'm
on
not
wheels.
sure Max would go with that. Christian, there are some hardcore fans, if you will, that are disappointed by some of the new tracks, including last year in Florida. Is there a risk that we sacrifice track and race quality for commercial and geographic expansion?
I don't think so. I think you've got to protect, the old circuits like the Monacos and the Silverstones and the Monzas. But then to bring in new circuits, I mean, we had Miami last year as a new venue. This year we got Las Vegas, and I have never seen hype around a race like that. I think it's going to be the biggest sporting event on the globe this year, and the demand for that race is off the charts. So, of course, the commercial demand for the sport is at an all-time high with 23 races at 23 different venues around the world. So, there's a mixture of street tracks and some of the old classic circuits. So I think it does cater for everything.
Christian, unlike some of the owners and the elites of Formula One, you've actually raced the cars. I'm fascinated what you think about the expansion to 4 more cars within Formula One. I know a $600 million buy-in is out there. To me, that seems low. But can the track take 4 more cars in that first dangerous turn?
I think that the tracks are certified to be able to take more cars. I think it boils down to the practicalities. You mentioned an entry criteria, and of course the commercials, like in any business, are going to drive the decision making. On this, effectively, you've got a 10 franchise set up at the moment that have their value through the exclusivity of those 10 franchises. And I think Liberty are keen to protect that as the custodians and the owner of the commercial rights holder. The FIA, the regulator, obviously they're looking to see, can more teams be accommodated? And so inevitably there'll need to be a compromise found at some point. But at the end of the day, it's going to come down to who pays for it.
Christian, you were talking about expanding to the U.S. and that things won't be sacrificed. But with the nature of the sponsors and the nature of the audience, which target audience are you going after? Is Formula One going after in the United States?
Well, we're bringing in a young audience, and we've signed up so many partners, recently, like Oracle and Hard Rock and Rocked and Cash App and so on. And of course, the big announcement for us last month was the announcement with Ford for 2026 on our powertrain. And we're looking to appeal to a younger demographic. Red Bull is an edgy team. We've got drivers that push the boundaries. We're a team that pushes the boundaries, and our following in the US is bigger than any other team. And I think it's only a matter of time in future years that an American driver will be running at the front in Formula One. And again, we want to be at the forefront of that. So we're looking to make sure that we protect the diehard fans, but that we attract a new audience, a younger audience, and a more diverse audience into the sport.
Christian, that's going to mean cheaper tickets, maybe. I was just looking at some of the prices in Vegas. It was cheaper for some of us on the East Coast, I think, just to fly to Europe, to go to Silverstone, Christian, than try and get a ticket at some of the tracks here in the United States. What can be done about that?
Well, look, I think it's supply and demand, isn't it? And the demand for Vegas is just off the charts. Anybody that's anyone is going to be at that weekend. I think it's going to be the most watched sporting venue, as I say, of the year. But we do need to look after the fans. We need to have a sensible, entry price that fans can come and see a Grand Prix, can see these incredible cars. Because until you see it live, you can't comprehend the speed of these machines and what a human being is actually able to control around the streets, for example, of Las Vegas. So that's a responsibility that we as teams and the commercial rights holder have to protect and look after, the diehard fans.
Christian, you mentioned Ford. They're going to have a role in the speed of Red Bull racing in a few years' time. Can you just discuss the risks around a new relationship with a new partner and when the planning really begins?
Well, for 2026, it's new regulations for a new engine. And we as Red Bull decided to take on that challenge ourselves as an independent, as a subsidiary of an energy drinks manufacturer, taking on Mercedes and Ferrari and now Audi and Renault and so on. So we felt that it was right for us to align ourselves with a manufacturer to give us access to some of the R&D that they're investing, for example, in electrification. And discussing with Jim Farley from Ford and Bill Ford, they were looking at Formula One, and therefore, a partnership with Red Bull was a very natural thing on both sides to do. And we're going to benefit from their knowledge and their technical know-how in, certainly in the electrification. And that process has started already, because 2026, as far as the engine's concerned, is literally tomorrow.
Christian, I want to bring up someone else over the weekend. I think you joked that there were 3 Red Bulls on the podium over the weekend. Number 3 was the Aston Martin of Fernando Alonso. Kristen, you've been in a car before. Can you describe how crazy it is what Fernando Alonso is doing in his early 40s?
Well, look, I mean, Fernando is a fantastic driver. He's, one of the best of all time. And he's finally got himself in a competitive car. And at 41 years of age, he's giving all the 40-somethings something to root for. And he's showed yesterday he's lost none of that racing spirit or drive or determination or skill. And, he's in great shape. And he's going to be a competitive driver and team this year for us. And we've got to, very much keep an eye on them, because I think they could be the dark horse of this championship.
Well, I was hoping that you'd say Ferrari, but maybe it's going to be Aston Martin. TK Ferrari they not getting it done over the weekend at all. Christian, congratulations on a dominant race weekend. I hope we can do this again soon, and please come to the studio here in New York when you make it over to the States. Christian Horner there of Red Bull Racing after a dominant race weekend.
What did we learn there?
Going forward, they really want to build out the expansion in America. Do you not get the sense of that?
Yeah, I do. They've got 3 races, I believe it is now: Austin, Miami, and Las Vegas, and it just screams L.A. or New York.
Well, and now the tension becomes, how do they expand into a U.S. base where you've got, basically Kardashians for racing, while also really catering to the fans? And that tension, how do you really placate the diehard fans while also dealing with U.S. insanity?
Complete amateur, but I can tell the difference between the heritage of James Garner in Monaco long ago and far away from the boulevard of Miami. To me, Miami wasn't Formula One racing.
Got to try and balance the two.
Yeah.
It's going to be difficult. It's going to be interesting to see how they do it.
I called Mayor Adams over the weekend. I said, can you fix a pothole at Lexington and 59th?
So it could be part of the circuit.
Be coming
maybe that's the way we fix the potholes here in New York City. Maybe that's how we get it done. Equity futures right now in the S&P, unchanged. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, President Xi Jinping said the country will take forceful measures to support the development of high-end manufacturing. Xi spoke at the closely watched National People's Congress. China's tech industry has been hurt by U.S. trade sanctions, and big electronics assemblers are setting up more facilities outside China. China reportedly will create a new regulator to manage the country's huge stores of data. That's according to the Wall Street Journal. The Journal says the agency would set data collection and sharing rules for business. It would also decide whether multinational companies can export data collected in China. Ukraine says that Russian forces are trying to cut off the besieged city of Bakhmut. The Russian attack is preventing Ukrainian troops from reaching residents who still want to evacuate. Still, analysts at the U.S.-based Institute for the Study of War says Russians will probably not be able to encircle Bakhmut anytime soon. President Biden sought to strengthen ties with black voters at a hallowed site for the 1960s civil rights movement. The president spoke in Selma, Alabama, to mark the 58th anniversary of what's known as Bloody Sunday. That was when white police attacked voting rights demonstrators. President Biden's approval rating among black voters has been falling. For the second time this year, Tesla is cutting prices. The electric car maker is reducing the base price for its Model X by $10,000 to just under $100,000. Model S will be cut by $5,000 to just under $90,000. In January, Tesla slashed prices up to 20% to boost sales. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
There are ways to stop inflations. There are really 2 ways, in fact. One of them is to tighten monetary policy, but the other way, interestingly enough, is actually to let the inflation happen. By virtue of having inflation, you eventually slow down and reduce the real balances, and the consumer feels squeezed. One of the reasons why I think that we're going to see a resumption of the trend in disinflation in the U.S. is for that very reason.
Terry Wiseman, fantastic from Macquarie just last week, looking for big things to happen in Europe and calling for European economic outperformance in the year ahead. Quite a call. Futures right now on the S&P, just about negative, just turning lower in the last 10 minutes or so. We're down 0.1% off the back of a decent weekly gain last week in the face. Some really big moves in the bond market. On the week, almost flat really on a 10-year, but still, at one point, had a look at 4% and some. Back down to 391.66 on a 10-year. On the session, Tom, down 3 basis points. Chairman Powell over the next couple of days, and then on to payrolls on Friday.
On to payrolls, but a lot of other data as well. And, of course, after payrolls, we launch across the weekend, John, into the inflation report, and retail sales is out there somewhere. Are we on a recession watch? I can't figure it out right now.
Based on the data we've had so far in the US, absolutely not.
It's just gone, right?
That might change. Things could really change in the next 2 data points we get from payrolls and CPI, in just the same way things changed after the previous payrolls report. All of a sudden you get a revision and something around 200k, the conversation changes. Have some sympathy for Chairman Powell going into this testimony over the next couple of days.
Huge.
He will get a payrolls report on Friday. Then when CPI comes out next week, it's the quiet period for the Fed. So they can't come out, or they could sort of leak things to the Wall Street Journal again, but in an ideal world, they shouldn't come out and say anything at all after that CPI print, Tom, going into the Fed the week after.
We'll just have to see, but I'm going to invent a new phrase right now. We've got secular stagnation, the land of Lawrence Summers and all that. It's not stagflation. It's resilientflation.
That's what it's been. That's nice. That'll work.
I think I did okay.
Find that on a South Side note near you.
On resilient inflation, Katja Trivedi joins us right now, head of global FX interest rate strategy, EM strategy at Goldman Sachs. Thank you so much for joining us, Dr. Trivedi. What I find fascinating here is the economic growth bolt-on to our persistent inflation. Does that surprise you?
Look, I think that our core view is still one where you're going to see economic growth resilience, as you mentioned, but some gradual disinflation over the course of the year. Now, it's true that the last releases for that have not been, very disinflationary, but I think there is a danger here that the market swings too far from one side to another, from worrying about U.S. recession risk in January to kind of no landing in February. I still think that you're likely to see a bumpy path lower in the inflation metrics, but these things are volatile. They take a few releases before you get that payback, and I think that is the real question for Chair Powell this week. Whether you get enough of the information or before the next Fed meeting.
Is dollar a movable feast? Does dollar here actually move on the surprise growth, the surprise resilience that we have?
The dollar has moved on the back of that resilience, although what I would say is that you need to take a slightly longer picture, right? I mean, if you look at the period sort of November, December, the euro appreciated on a trade-weighted basis because we re-rated European growth higher. Then we had a phase, December, Jan, where the CNY re-rated higher because we had China reopening and a pro-growth pivot there. And most recently in February, we've seen the dollar move higher because we've, got evidence of suggesting U.S. growth resilience. So when you look at any one of these things, it looks like, it's just the U.S. and the U.S. is exceptional. But the reality is when you step back and look at the past 3 months, the reality is global growth is more resilient. And that's what's pushed rates up everywhere with a much more choppier backdrop for currencies.
Narrative follows price. We were talking about that at length last week, but also we heard about that from Morgan Stanley over the weekend. Andrew Sheets talking about a number of narratives that have gained traction in markets because of where the price is that they question. One of those is that inflation is as sticky and as problematic in Europe as so many people think, that the year-over-year comps are going to make inflation actually go down much more significantly in Europe than people are expecting. Do you agree with that?
Look, I think that I do agree with the broader picture, which is that, yes, I think European inflation will also, peak and decline, especially on a headline basis, given what you're seeing on the commodity price side. But I think that, this is going to be a slow process. We've come out of a period sort of towards the end of last year where we had some, helpful inflation releases across the world. And, more recently, we've had a period where the inflation releases have been, surprising to the upside again. This thing takes time. It's going to be up and down. down. And in particular, core measures are going to be stickier and still end the year at levels of inflation that central banks are not going to be super comfortable with. They're going to be substantially above target. So will it decline? Yes. But is it still going to be pretty sticky and high that, central banks will want to maintain the rhetoric of higher rates for longer? I think that's still going to be with us even towards the end of the year.
But there's a question about differentials. And if you do see greater than expected disinflation in Europe, albeit at very high levels, does that mean that the euro has a lot more room to depreciate versus the dollar, where there potentially could be a stickier, less energy dependent aspect to price increases in the pace of them in the U.S.?
There's certainly that can certainly happen, but I think it also depends a little bit on what the global growth backdrop is. Typically, what we have tended to find is that in environments where growth is strong, in most parts of the world, including in Europe, the dollar tends to weaken somewhat at that point. And so really, I think that both Europe and the US are places where probably rates can stay higher for longer. I think the depreciation is more likely to come amongst jurisdictions which are likely to fall off the pace of the hikes that these two jurisdictions, the US and the euro area, are providing. So I would be more cautious on places like the UK, like Sweden, which are likely to kind of fall off that hike pace.
But Kamakshia, when you talk about a stronger dollar, and the reason why I'm focused on that, I wonder what that means for the emerging markets trade, which has been so hot so far this year. You get like a 1-2 punch where you've got China coming out overnight and saying that they're expecting a 5% below expectations for growth this year. And then potentially you could see more dollar strength than many people thought. What does that mean for this trade that so many people piled into?
I think it does mean that from the on the sort of local side of things, it is more challenging because you have the dollar moving back towards a slightly stronger level. And particularly, it means that for the very, very vulnerable parts of the emerging market complex where, spreads are pretty much, already at distressed levels, some of those are going to find it really challenging. We saw a huge glut of issuance from emerging markets in January, but most of that was investment grade. Amongst the high yield segment, you saw very little. You saw even, very little again in February, given the move higher in rates. And so what it tells you is that for the riskier group of emerging markets, financial conditions still remain pretty challenging and are likely to remain so for the months going forward.
Kamakshia, thank you, sir, for being with us. Kamakshia Trivedi there of Goldman Sachs on the global economy, foreign exchange. Let's talk about disinflation over at Tesla, shall we? The Model S and Model X now start at $89,990 and $99,990 in the United States, down a respective 5.3% and 9.1% respectively. More price cuts, Tom, over at Tesla.
The whole electric thing, I think, is going to be fascinating because I'm seeing price cuts, and I'm also being told by friends they're waiting 5 years to get a car. I don't know what to think.
When I talk to car executives, they say basically Tesla got greedy and their margins were so fat. And basically now they're trying to bring down the margins a little bit and then corner the market. And that basically is the theme, that it's not necessarily because of a lack of demand. It's because they want to be the dominant player and there's so much competition that they might have to accept a slightly smaller margin. But their margins still are incredible. So I think that that's really what people are looking at.
And these price cuts may hurt their competitors more than it hurts them.
Correct. That's the thinking.
This is what Elon Musk said at Investor Day back on March 1. Tesla's Investor Day. We found that even small changes in the price have a big effect on demand. Tom, his words, very big.
Yeah, I agree with that point. And I just wonder when the brand destruction comes in where you're perceived as a lower price point car. That's got to happen at some point. It may be 1, 2, 3, 4, 5 cuts down.
We're still talking about a $90,000
exactly.
car. So, at what point is this a low-cost car?
Well, they're trying to get the cheap ones out eventually to compete with, what was it, the Nissan Leaf we decided Bramo has to have?
Yeah, I'm not sure that's the car they're competing with. No.
But is that the car America's going to buy? At $38,000 plus the $695 two-tone paint job.
This country's proven itself to be very reluctant about buying small cars. I mean, let's face it, when it comes to EVs and being green, for some of these cars, you'd be better off buying an internal combustion engine in a small vehicle than getting, say, the electrified Hummer. That's better for the environment.
But
just
it
get the
doesn't
small.
look as cool.
Precisely. So why don't they talk about that? It's not about going green. It's about looking cool.
And feeling less guilty about it. How do you feel about that?
I think everyone knows. Everyone knows. Futures negative a tenth on the S&P. David Leibowitz at JP Morgan coming up next.
We're in this brave new world where we have more political, geopolitical risk, more fiscal, higher inflation, higher rates.
By virtue of having inflation, you eventually slow down and reduce the real balances, and the consumer feels squeezed.
There's still a lot of excess buffers in financial markets and among households.
Ultimately, it's a question whether the Fed takes the high road or the low road, proverbially and literally with rates.
If we do get to a 6% rate and have to hold at 6%, I think we're increasing the probability of a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
A double dose of power coming right up. The Fed chair on Capitol Hill tomorrow and on Wednesday too. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Equity futures down by about 0.1% on the S&P. TK, we have to start in China, then make our way over to the United States. A 5% growth target out of China over the weekend.
Resilient growth target there, and resilient is the word of the day. I think I've seen it in 3 or 4 notes here. It's the bolt-on of what happens to economic growth given all the angst of the week. Jobs, inflation, retail sales, name the economic data. What does it do for economic growth? And what the adults are saying is resilient.
The jobs, 517,000 in America. Retail sales, a 3 handle, and inflation still too sticky. Arguably, we've said this a few times already this morning, Lisa, but for those just tuning in, arguably, the best news they've had for Chairman Powell and President Lagarde is probably that modest growth target out of China.
If China isn't going gangbusters, that means that perhaps inflation isn't going to have the same kind of negative or approach for what they have to do. In other words, this could actually dampen potential inflation expectations just on virtue of nothing else on energy demand. That said, I think today is the great reset. We've had already January, where it was just, gloom and doom that was just shattered. And all of a sudden, people were excited about the great disinflation. And then February, everyone's worried about runaway inflation that's never going away. Have we overshot one way or another? This is the reset.
We said on this program 2 years in 2 months. I've got no idea how many decades March brings. Equity futures right now down 0.1%. Let's whip through the price action for you. In the bond market, shaping up as follows. On a US 10-year last week, a 4 handle this morning, back to 392. Some calm here, 392.84. Yield just a little bit lower, Lisa, by a couple of basis points.
Let's set up the week. It's going to be a really important week of central bank talk, of government discussions, and of course of the data. We're looking at Fed Chair Jay Powell, as John was mentioning, testifying on Capitol Hill on Tuesday and Wednesday. On Wednesday, we also get a Bank of Canada decision. And on Friday, this is going to be really interesting. It is the last Bank of Japan decision overseen by Governor Kuroda. Does he give a surprise before he leaves? Does he say to Ueda, all right, I'll throw you a bone or I'll make your life miserable? Let's see what he does. On the government side of things, President Biden is going to release his full year 2024 fiscal budget on Thursday. Very curious to see what he projects in terms of spending and how he sort of bridges some of the gaps. And then also what kind of support is provided to Ukraine. He is hosting European Commission President Ursula von der Leyen on Friday. And on the data front, we are expecting jolts on Wednesday, the job openings data. Friday's data point, John, might be one of the most important over the next couple of weeks, if not the most important. It is the report for the jobs, the employment report for the month of February. Do we see this confirm what we saw in February? If it does, how much does that change the market narrative? And if it doesn't, do we see that whipsaw back to January's disinflation? I mean, is this basically going to cause the swing in the other direction?
How big does that need to be to put 50 on the table at the next meeting, which will frustrate a lot of people because this is backward-looking data to make forward-looking assumptions about where the dot plot should be like back at the back end of 23, but you know where the conversation's going to be.
You can start normalizing and averaging out some sort of trend, which is something I know, Tom, you've been talking a lot about, the average. And all of a sudden, if you get a 400 print or something outrageous, or even a 300 print, and it's not revised down, all of a sudden, you are going to have a very different conversation about how high those
I'm looking more at 3-month annualized, which is what the street's done over the years, and I think it's in vogue. You take 3 months data and annualize it. Forget about that right now. If we get surveyed, John, with no revisions on this jobs report, that's 992,000 jobs formed in 90 days, or 331,000 per month.
It's pretty phenomenal, isn't it?
It's unheard of. It's not phenomenal. It's not in the range of thinking.
And we're doing that with a Fed approaching 5%. The Federal Reserve Chair used the phrase in the last couple of months. He said the disinflationary process has started. And our next guest had something to say about that. David Leibovitz, Global Market Strategist at JP Morgan Asset Management. David, I remember you saying it, your words. You said that phrase might go on the shelf with transitory. Has that gone on the shelf with transitory?
I think it has. I mean, when you look at the data that's come out so far this year, whether you look at the hard data being the jobs numbers, whether you look at the soft data, I mean, the survey data for February was very robust. This is clearly an economy that's proving to be more resilient than a lot of people expected. And I'm not sure that that disinflation the market was really grabbing onto at the start of the year is necessarily going to come through. I mean, particularly when you look at where job growth has been most robust, where wage growth has been most robust, it's in leisure and hospitality, it's in the service sector more broadly, and the reality is that services are not really showing any signs of slowing down.
Don't talk down to leisure and hospitality. That's what we're doing right here. We're leisure and hospitality. I mean, that's what we do at Bloomberg Surveillance every day. You're in the calm, patient, long-term business. What do you say to JP Morgan clients in a panic about the people that say not only we're going to drop, but we're going to drop at some point precipitously?
So I think the first point that we've been trying to make to people is that a lot of folks are suffering from recency bias, right? When they start to get agitated, they immediately think about one of two things. They either think about 2020 or they think about 2008. Statistically, those are very much outliers. And so when we look at the fundamental data, when we look at, say, the cyclical sectors of the economy, we don't really see anything that is so far off sides that it suggests an outsized downturn when one does materialize. And so I think what we've been trying to lean on is, look, this economy has more momentum. And yes, that has implications for inflation. But if the Fed decides to crash the ship at some point down the road, we don't really see the pieces in place the way that they were, say, in 07 and 08 with respect to housing, and certainly don't foresee another global pandemic coming anytime soon.
What would it take for the Fed to crash this party?
So I think, the one thing that we've been spending a lot of time thinking about is that at the end of the day, this is really an exercise in central banks and the Fed in particular defending their credibility. I mean, the Fed can get inflation to wherever they want it to be. They can get growth to wherever they want it to be. The question is what needs to happen to rates, and more specifically, what does the terminal rate actually look like? If this is a more inflationary economy, what that means is that R star isn't 2.5%. It's probably somewhere higher, and that has implications for what the Fed needs to do in order to snuff this inflation candle out. And so to me, the worst case scenario is a Fed that gets very frustrated with their seeming inability to get inflation back into check, and they keep hiking and hiking and hiking and throw that whole theory about leads and lags and it takes time for this to work its way through the economy very much into the wind. That's the big risk to the economy this year.
So how do you game out that risk in your investing? Because right now you're talking about perhaps we're not going back to another 2007, 2008 kind of crisis. So if you see resilience, that could be good for stocks, not necessarily bad, unless there is that downside risk.
Well, I think it's good short term. And I think that a lot of the concerns about profits are going to collapse by 30% that we've talked about together over the past couple of months, that's not necessarily going to come to fruition if the economy is still humming along and inflation is taking longer to come down. So I do think that near term, there is an opportunity in risk, and risk could certainly end up performing well again in the short run. I think that the challenge is, how do you get inflation back in the bottle? Well, you reduce demand. And at some point that shows up in corporate revenues and corporate profits. And when earnings begin to really fall apart, that to me is what's going to lead the market back down, not necessarily to a new low, but perhaps the levels that we saw back in October and June of last year.
Do you see evidence that earnings are quote unquote falling apart?
So I think that earnings estimates are coming back down to earth, and I think that that's a good thing. The 2023 number is down, call it 7-8% so far year to date. The challenge is when you think about what the market price is off of, the market price is off of a forward multiple. So every day that we go through in 2023, we're picking up a year of average earnings in 2024 because those estimates certainly don't reflect
Where's that multiple? Where's
reality.
that statistic right now? Where's the multiple forward right now?
So the forward multiple is about 17.5, 18 times today. We think that's about 2 turns expensive relative where it should be. And furthermore, it's really a question about 2024 earnings because everybody was talking about how this was going to be a year where profits came under pressure. But if the economy is proving to more resilient, that story is getting shifted down the road. And I'm not sure that markets necessarily appreciate that. And I certainly don't think that it's in the price.
So what do you do with the frenzy of tech priced out at 22.25? Some of it's growthy, some of it's less profitable. But there's a lot of cash flow generators there as well. Are they worth that premium off 17 and 18?
So I don't think that they're there quite yet. I don't think that they're necessarily worth it yet. The reason why is that when we look around the markets today, there are plenty of other interesting things to do. I mean, the layup continues
but are they
to
value
be.
traps? This is the key question. Is John Deere or whatever trading at 9, 10, 12 times earnings, are they value traps where they sit there forever?
I only think that they're value traps if the Fed returns to zero, and I don't think that the Fed is returning to zero. I think my base case assumption is that there's going to be some sort of cost of capital in the market going forward, and that's going to make equities less about one thing, i.e., mega cap, long duration growth, and a bit more balanced like we saw in the past. I actually think businesses that can generate productivity are going to be the ones that perform best in this environment, because investors aren't going to reward earnings growth simply that is a function of rising prices, right? They want to see business plans changing, and that's going to make or break investments going forward.
You say value traps, and I just think Europe. And then it feels like something's changed. Yet today, European banks, David, they're flying. What's that about?
So I think part of it is the sigh of relief trade. I mean, it's been, a decade since the Eurozone crisis, and Europe finally seems to be kind of shaking off its scabs and coming back into the limelight. I think part of it might be a very long overdue dead cat bounce. I also think generally there's an expectation getting baked into that market that the ECB is going to have to do more. And like the Fed, when the ECB pauses, it's going to be a pause. They're not going to turn around and cut. Generally speaking, that's just a healthier environment for the banks. And furthermore, the European banks are very different today than they were in 07 and 08, seeing much better behavior is the way I would categorize it.
What's that Disney line you used, Tom? A Whole New World.
It's a whole new world.
That's from Aladdin.
Great. That's great.
It's a song. You never saw
Disney.
Yeah, I know, but did you ever see it?
Why would I refer to it if I didn't know what movie it was about?
Well, I don't know. I thought maybe you were just saying it's a Disney song. It sounds like it. He goes off on
Aladdin?
this.
Forget it. David, thank you. David Leibovitz of JP Morgan. Why would anyway?
Did you watch it?
Of course.
Do you know that song?
Yes, I watched the new one too.
Oh wow, really?
Yes.
That's devotion.
Yes.
Okay, I take it back.
Lisa, where's Lisa? I'm well researched.
You came in prepared. Okay,
of
fine.
Of course I'm prepared.
Okay.
This weekend,
talk about things I know
we're getting
about.
ready for the Oscars, David. This weekend, Mrs. Keene is sitting there with vet bill on her lap, begging me to watch Top Gun new one.
Maverick.
So I'm not a tool.
It's emotional.
And
so you're not a
you're
tool.
watching Aladdin.
Watch that at the cinema.
Different kinds of things.
Yeah.
Why did I not know
Aladdin
that?
in the cinema?
No, the new one and the old one too. The old one, the cartoon version, was in the 90s, wasn't it?
Oh, I
Early
remember
90s.
we went out with friends.
You know what the power of this is?
Big day out that was, Bremo. Back in the day.
Let's move on. Look at those markets.
Futures down a tenth on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China has set a modest growth target, suggesting that there will be less of a boost to an ailing world economy. Beijing's goal for gross domestic product growth this year is around 5%. Economists had expected a more ambitious target following a rebound in consumer spending and industrial output. U.S. lawmakers are stepping up the push to ban TikTok. Senate Intelligence Committee Chairman Mark Warner plans to introduce a bill this week to allow the U.S. to systematically ban Chinese technology, including ByteDance's popular video service. One of the concerns is that TikTok gives China access to Americans' data. There's been a breakthrough in a long-standing feud between Japan and South Korea. The South Korean government says it would resolve a dispute over people forced to work for Japanese companies during Japan's colonization of the Korean Peninsula. The conflict has disrupted relations on everything from trade to security. A second Norfolk Southern train derailment in Ohio has Congress calling for rail safety legislation. Saturday's derailment happened outside of Springfield, Ohio. Now that's about 180 miles just west to East Palestine, and that's where a derailment spilled toxic chemicals last month. The CEO of Norfolk Southern will be questioned Thursday when he testifies before a Senate committee. And shares of Apple, they're higher today. Goldman Sachs is recommending buying Apple for the first time in almost 6 years. Goldman was mostly on the sidelines as the iPhone maker's stock more than quadrupled in value. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
In 2016, I declared, I am your voice. Today I add, I am your warrior. I am your justice. And for those who have been wronged and betrayed, I am your retribution. I am your retribution. We will evict Joe Biden from the White House. And we will liberate America from these villains and scoundrels once and for all.
The former President Donald Trump there over the weekend at CPAC, and not the only potential presidential candidate speaking. I say potential, he's formally in the race. This guy is not. And I would say yet. Ron DeSantis, the governor of Florida, with this to say in California on a little bit of a media tour himself. He said, we've witnessed the great American exodus from states governed by leftist politicians imposing leftist ideologies and delivering poor results. And you can see massive gains, Tom, in states like Florida, who are governing to the tried and true principles that President Reagan held dear.
Well, he's selling to California and Reagan, and particularly Southern California as well. But, John, you bring up an incredibly good point. There's lots of toes in the water here. I mean, I think every candidate is putting their foot in the water. And the governor of Maryland, Governor Hogan, a moderate, I think Mr. Trump would suggest Republican in name only, he's not even going to put the foot in the water.
Well, but how do you take a local appeal and broaden it out more generally?
That's the
and with
heart of
Ron
the matter.
DeSantis
Yes.
talking to California, there was a lot of analysis about how he missed a lot of the nuance, and understandably nuance doesn't sell, but the visceral response to just how high housing costs are in some of these states, and that the reason why people are coming to Florida is not for some political or moral indictment. But it's just more because that's where it's cheaper. It was anyway, until a lot of people moved there.
Taxes, TK.
Yes.
Taxes.
Heart of the matter. Heart of the matter. I'm sorry, that's all there is to it. And some people leading this morning with the idea Mr. Biden's floating out some form of taxes. Greg Villiers tore him apart this morning in his note with AGF.
What did Greg say?
He just said it's dead on arrival. He just said the budget today and tax lift.
But aren't all these budgets dead on arrival,
yes,
Tom? What's
yes,
new about that?
and true, and in England as well, right? I mean,
no, the budgets usually
it's a different process.
They usually get done in the UK.
Yeah.
Parliament has a majority if you're the governing party, and then you just do it.
Let's go.
I feel aggrieved.
In our 18-month campaign,
let's sort of talking points.
Whatever.
Let's try to get to August of next year. We're going to do that with Amory Horta and Bloomberg, the Campaign Lasts Forever correspondent. Amory, I went back. I remembered a story during the impeachment stuff from Dion Searcy of the New York Times, and she beautifully identified not only on the left and on the right, but in general, aggrieved America. Boy, did it sound like President Trump was speaking to his aggrieved constituencies over the weekend. How does he expand away from the aggrieved now?
Yeah, he certainly was, and that was on full display at CPAC, right? You have individuals dressed up in full-on Trump gear, holding Trump signs. Clearly, in the polls at CPAC, he was the lead winner, but others, like Governor DeSantis, was not there. He was a little bit more on a national toll. The issue right now with the Republican Party, and you have the likes of the former governor of Maryland backing out, is because it is very wide and broad. And Trump still has a strong grip on about 30%. So what the Trump campaign is thinking is if they could deflate the others, most notably the number one challenger would be, once he enters, Governor DeSantis, then they can have basically what happened in 2016, which was this huge field of some 16, 17 people that he was unable to win the plurality of. So he has that 30% grip. It's about whether or not the moderates in the party, or potentially those that are conservative, but many in the Republican Party would say don't have the baggage that Trump brings, is one of them going to be able to take
I'm going to go almost counterfactual here. I sound like Neil Ferguson, but I'm going to go there anyways. How does Haley, Pompeo, DeSantis, and the rest, how do they address with respect the GOP aggrieved?
It's a great question, and I think you're going to see them doing it in different ways. I think when you see Governor DeSantis, he really wants to make it about policy. You heard him over the weekend at the Reagan Library talking about conservative policies, what he's going to do. And we have the Republican legislature kicking off this week that spans from tons of issues that he would call is really getting rid of, quote, woke education, woke capitalism in his state. He's going to go on a national tour promoting what he was able to do with this large Republican majority in Florida. So if you look at his calendar, he's going to Nevada, he's going to New Hampshire. Him and the former President Trump are both going to early state voting Iowa. So that is his take. You see, it might be a little bit more difficult for the likes of a Pompeo or a Haley to go after Trump because obviously that's their former boss. But already you see Mike Pompeo on a recent Fox News saying that he didn't actually think the former president is actually that conservative. He insinuated that because he was talking about raising of the federal deficit.
When are we going to hear about President Biden and his potential re-election campaign?
Well, it's interesting because this week Biden is going to unveil the budget. He's not just doing it from the White House. It feels almost like a campaign event because he's taking this budget unveiling with a lot of fanfare to Philadelphia. And in this, it's coming from what many expect him to announce, which could potentially be in April or in May. Basically, his wife said all they have to do is set the date. But also it's a way for him to set aside what he envisions for the country versus Republicans. Now, Greg Valliere, I read that note, Tom, this morning. He said it's a thud. It's a dead on arrival because Biden is going to propose tax increases for a lot of what he wants to do. The past Congress couldn't get tax increases done, and the Democrats held the control. But what Biden really is going to say is to America, this is my plan. I want to make sure Medicare, I want to make sure Social Security are solvent, and I want to raise taxes on the richest in this country and the corporations. Republicans, show me your budget. So it's a twofold event for Biden, but I do think it's something about him and sort of a pre-campaign event.
Are there any is there any talk about a pipeline of potential other Democratic candidates, just in case perhaps things change in a year or change in 6 months?
Well, sometimes there's whispers about this, but Senator Joe Manchin was on the Sunday shows over the weekend, and he wouldn't say whether or not he would run for 2024. There was this idea a few months back that potentially you could have this third-party candidate. Senator Manchin is up for re-election for his Senate seat in 2024. We already know that Republicans are going to heavily, aggressively campaign for that seat. But he wouldn't say also directly if he would back President Biden. So at this moment, there's not huge talk of it, but there are some fractures there. And you could see some potentially other people eyeing to get in if Biden doesn't go the full way.
Two things, message and strategy. The message, Anne-Marie, in the last election, the message was clear. He was going to try and unite the country. Some people have criticised him about the way he's governed, not in that direction. The strategy, the last time around, was just to step to the side and let President Trump make it a referendum on him. I just wonder how two things, message and strategy, will change this time for the sitting president.
Well, I think it a lot depends on who the Republican candidate is. Because if it is former President Donald Trump, some of that strategy could potentially be redone. Many individuals and polls you do see Biden still beating a Trump if it is a clear rematch of 2020. If it is a different candidate, you're correct, Jonathan. That strategy and message is going to have to change because what the heart of the country, like the center middle, really you see from the polling of 2020 is they wanted to go back to a little bit more of a normal Washington and get rid of some of the noise. Now, if the Republicans put forward another candidate, a more moderate candidate, a Governor Sununu, a Nikki Haley, I wouldn't say he's moderate when I look at Governor DeSantis. He's definitely on the conservative side, but some of that noise and baggage he might not come with. I mean, Trump has been going after him with nicknames, and he has yet to fire back. Potentially, the Biden administration, their campaign, is really going to have to change course.
MH, thank you. Wonderful as always. Tom, it's just so early in the process. So early in the process.
It's a sanctuary here.
A sanctuary for Manchester United fans and
everybody but Red Bull and also those just, are you kidding me? We're starting this now.
You bring up Man U. That was brutal.
Almost as bad as the Tots. The Tots were worse.
And Milan. Not great.
It took you 90 minutes. I just want to say that.
No.
90 minutes.
I still, just a little bit, a flame.
Not a sanctuary.
Equities look a little something like this Monday morning. Good morning to you as we kick off a new trading week and look ahead to the chairman of the Federal Reserve speaking over the next couple of days. Senate Banking Committee tomorrow, House Financial Services Committee on Wednesday. He goes twice, a double dose of the chairman. Going into that, futures negative on the S&P by not even 0.1% after a decent week of gains, up about 2% on the S&P 500 last week. Biggest weekly gain going back to January on the Nasdaq. We're just about unchanged on the Nasdaq this morning as well. In the bond market, yields look a little something like this. On a 2-year, a new cycle high last week of 4.94. Right now, about 10 basis points south of that level at 4.83.99. Yields in about a basis point. This curve gets even more inverted, led by the long end. The 10-year down another 3 or 4 basis points. 391.47, Tom, last week. North of 4% for the first time since November, I believe.
Can we pause? Not only with the 210 the vanilla spread, 93 basis points. I'm not in the 100 basis point watch. 20 minutes ago, a headline that is stunning. I sat in the turret of Bloomberg surveillance in 07 and 08, John, with a 5% 3-month LIBOR. And I know LIBOR is drifting away in memory, but it's still what everybody hinges off of, the loan business, all the debt business and that. 3-month dollar LIBOR tops 5% for the first time in 16 years. That is, there's no other headline today. That is the headline that everybody, including Chairman Powell, has to adjust to.
Speaks more broadly, Tom, to what's happening with rates universally. If you think about where the 2-year was in the last week at 4.94, we haven't seen those levels either since 2007. Quite clearly, the Fed just hasn't been at these levels since the pre-financial crisis days.
Jerome Schneider visiting us last week, Ian Lingen, people like Ira Jersey at Bloomberg Intelligence, they know the way that all of their world is hinged to 90-day LIBOR. And that's a huge deal. It's bigger, John, than Dow 10,000. And you know how big Dow 10,000 was.
You went that far.
Thank you.
You know, because that was a big day.
There was a big day.
Oh, it's a huge day.
It's like 100 years ago.
I want to finish on foreign exchange, euro-dollar, just briefly. This tug of war between what we've seen take place in the United States and this really robust data out of Europe. Eurozone inflation data last week, core CPI all-time high. Euro-dollar last week was just really, really flat. Really flat. It's like that tension through the rope of that tug of war, Bramo, on both sides, and we'll see what breaks.
Especially given the fact that inflation is a problem on both sides, is surprising to the upside on both sides. And how does that play out with respect to growth and the response mechanism within the central bank? Sticking in Europe, I wanted to take a look at Credit Suisse. We were talking earlier about David Harrow, one of the longest-standing shareholders of Harris Associates, withdrawing his full investment, selling out of Credit Suisse after holding that position for a very long time. We're seeing those shares lower by about 2.3%. And John, you was reading the quote earlier, but really I just want to reiterate this. David Harrow saying we have lots of other options to invest. Why go for something that is burning capital when the rest of the sector is now generating it? And we have seen that throughout the banking sector in Europe. We're also taking a look at Apple shares. Goldman Sachs recommended buying Apple for the first time in almost 6 years, and you're seeing those shares up about 1.3%. And I think that it's interesting to see Tesla shares barely moving after cutting prices for the second time this year on a number of their models. We talked about this earlier. How much is this some sort of statement on demand and the price point? And how much is this a statement on, we want to cannibalize all your business competitors, and if we can cut a little bit, we can do it. So, you know, go make it work.
You know that phrase, your margins, my opportunity? Mm-hmm. It's like my smaller margins, your problem. Seems to be the message from Tesla.
They don't have to go that much small. I mean, honestly, their margins are massive relative to other auto manufacturers, so they don't have to really suffer that much if they want to get perhaps a little bit more traction.
That stock not doing too much this morning. Equity futures not doing too much either. We're down about 0.1%. I imagine that might change through the week. A massive week ahead. Fed Chair Jay Powell testifying in front of the Senate on Tuesday and on the House on Wednesday, ahead of the highly anticipated jobs report on Friday. Over the weekend, we heard from Mary Daly, a Tom Keene favourite, the San Francisco Fed president.
She is.
The message basically higher for longer. She said this: it's clear there is more work to do in order to put this episode of high inflation behind us. Tom, further policy tightening maintained for a longer time will likely be necessary.
Longer time. There's the x-axis there, and that's been the shock here of 22 into 23. Not only here, but in Europe. If you are part of America, global Wall Street, it's time to stop and lean forward. Eric Nielsen has been at UniCredit since the advent of the Italian Republic. He joins us now, Chief Economics Advisor at UniCredit, and truly one of the great optimists on the European experiment. He nailed that coming out of the crisis of Greece and such. Eric, thank you so much for joining us today. I love your research note where you say ECB and others have it wrong. just stop focusing on core inflation. Why is that?
Hey, Tom, good to be back. I think it's that people are way too concerned, particularly here in Europe, less so in America, but way too concerned about these inflation numbers. They are driven predominantly by the cost of energy that then has spilled through, of course, to the core numbers, as they naturally do for a while, and then they come back again. It's so hard to argue in Europe that we have excess demand that drives inflation. So this is coming down again, and I worry that ECB is overreacting to it.
Do they have the policy elasticity that if the ECB, or for that matter, the Fed and others, overshoot, that they can turn around and right the ship quickly?
No, they can't for two reasons. The simple one is pure pride, right? I mean, you're coming up and you say, oh, my God, we overtime, let's turn it around. I mean, that is just a natural kind of inertia about that type of thing. But the other side of it is, remember that monetary tightening takes about at least 6-9 months and up to 18 months before it really is felt. So you're going to go into this period with high interest rates, then inflation comes down, and growth is going to slow down, and demand is being squeezed. Then they see it, unemployment goes up, and say, oh, my God, we did too much. And then there's a pride element. Then they start, and then the damage has been done before the effect of some easing comes about. So I'm very worried about that part.
So if this is a matter of pride, and if we don't see the effects of some of these rate hikes for a while longer, does that mean, from your vantage point, Eric, that you think people are overly optimistic about European growth?
Yeah, I think there is a concern about this. Admittedly, I was wrong. I thought this winter would have seen a bit of a recession, and it looks like we are skirting just short of that. But come next winter, when the full effect of the ECB tightening is going to be hit, when the excess reserve savings in the household sector is coming down, and as we see some retrenchment on the fiscal side, certainly removal of stimulus, I think the numbers will be lower than what you see by consensus and most forecasters. I'm not talking about a deep recession, but I certainly expect a lot less than is generally perceived in markets.
How could that potentially get played out in markets that could be problematic for the ECB? Namely, I'm thinking, could this make the euro weaker versus the dollar if you start to get concerned about the economic prospects, which just imports inflation and makes things a little bit more tricky?
Yeah, I think that's exactly right. I mean, it's at the end of the day, FX markets are very difficult, right, as we all know. But it is ultimately the difference between growth with your dollar, the growth prospect, and the carry of the interest rates, right? So certainly, yeah, you can certainly see a downside or closer to parity again. I'm not in the camp who thinks we're going to go through parity, but it's probably a bit weaker from here, I could easily imagine.
Eric, in your optimism on the European experiment, you've always said they'll get along. Are they getting along with the Bundesbank now? The central nexus, Netherlands, Bundesbank, and others, what is their strength, their power now into the rest of the year?
Yeah, that's a good question, Tom. Let me start by saying I think the Bundesbank is a much more productive member of the Euro system now than it was before, where you had Jens Weidmann coming out and attacking the bank in the press. That's not helpful. And I think certainly Nagel, the Bundesbank president now, is doing this much better, more professional, and Isabel Schnabel at ECB doing a fantastic job in this. I happen to disagree with the stance, but this is something reasonable people can disagree on, I think. So I think they are too hawkish. It's very clear that it's the Northern European, it is Klaus Nord at the Dutch central bank and the Germans and some of the Northern Europeans who are driving this at this stage and have basically instilled fear in everybody because the actual inflation numbers, including core, are way too high. But we know that monetary policy shouldn't react to present numbers, and that's unfortunately what we are seeing now, also in America to some extent.
Well, Eric, to your point, they're quieter now because they're getting what they want, higher rates, Eric. And as you know, with the ECB and any central bank, it's not what we want them to do, it's what they will do. Eric, as you anticipate their next meeting, they've led us to believe they'll go 50. Do you expect them to set the stage to go 50 again? at the next meeting?
Yes, I think they will. Yes, I think, John. I think the next one is 50. That's a virtually given now. I mean, they always said it, and Christine Lagarde has virtually confirmed it. Incidentally, an interesting degree of forward guidance, right? And then I think certainly in my mind, I had hoped that they would then slow it to 25 and then maybe another 25 in about 3.5. Now I think overwhelmingly likely they're going to do at least one more. So that is 2 more from here of 50. And I think a terminal point in Europe of 4% is the more likely now, unfortunately.
Eric Nielsen of UniCredit. Eric, wonderful to catch up with you, sir. As always, just brilliant on the Eurozone and the ECB over the last few decades. Tom, Otmar Issing, speaking to Bloomberg over the weekend.
I missed this.
The former Bundesbank chief.
Yes.
He said this: I expect that we will see wage increases. We will create new inflation shocks. That's a very different take to what you heard there from Eric Nielsen.
This is profound, and just to the point that I spoke of the Bundesbank. This is classic Bundesbank. I'm going to center that around Dr. Issing. Axel Weber would be another voice along this line, and they're linking right over to, granted, there's war shock, there's pandemic shock, there's supply shock, but what you hear there is demand economics from Dr. Issing that it'll be inflation. And the key thing is LIBOR here is 5%. I just looked up German LIBOR, can't remember it exactly, it's 2.8%. That's that oomph difference between the two societies, and you get a wage spiral there with a lesser inflation.
What do you make of the Eric take on things, that we might be on the brink of making a bit of a mistake here?
I'm a big fan of Dr. Nielsen. He was legendary at Goldman Sachs running their economics, and he's done a great job at UniCredit, being optimistic when people weren't. So when he says ignore core and look at other things, he's got my attention.
It's amazing, isn't it? Over the last 10 years, optimistic when people weren't, and now everyone's optimistic, and he's like, slow down. Slow down a little bit.
You know, I'm not going to mention the town he lives in because to protect his privacy, but Johnny's got the big life there on the River Thames.
I know.
The
he's got his favourite coffee shop and the Sunday Note. Sounds great, doesn't it? Do you want to make that happen?
I think we should make that happen.
We should join him in his favourite
coffee
shop.
He's right near a brewery.
He's hiding right now.
Like you can go get a beer, not a pub.
It's perfect.
A brewery.
I know exactly where you mean.
You know exactly.
I won't say it either. Futures on the S&P, unchanged. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, President Xi Jinping said the country will take forceful measures to support the development of high-end manufacturing. Xi spoke at the closely watched National People's Congress. Now, China's tech industry has been hurt by U.S. trade sanctions, and big electronics assemblers are setting up more facilities outside China. Ukraine says that Russian forces are trying to cut off the besieged city of Bakhmut. The Russian attack is preventing Ukrainian troops from reaching residents who want to evacuate. Still, analysts at the U.S.-based Institute for the Study of War say the Russians will probably not be able to encircle Bakhmut anytime soon. Chancellor of the Exchequer Jeremy Hunt is facing a tough challenge ahead of his first budget due March 15th. UK borrowing is running well below official forecasts, but there's little room for giveaways due to weaker underlying growth. This as public service workers strike over pay and households struggle to meet living costs. Credit Suisse has lost one of its biggest backers. Harris Associates stock picker David Harrow has sold the firm's entire stake in the embattled Swiss bank. Harris Associates was one of the biggest shareholders in Credit Suisse for many years, but by the end of last year, it held only a 5% stake. Shares of Credit Suisse hit a record low last week. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
This has been a problem child. We've owned this bank literally since the early 2001. And the first 10 years was a very good holding. I mean, it literally went from 20 to 60 or 70. Now, what we should have done is just sold it, and that's it.
Now it's back to 2. And he doesn't own it anymore. That was David Harrow, the Deputy Chairman and CIO of International Equities at Harris Associates, speaking to Bloomberg last summer, back in August. This is what he told the Financial Times over the weekend. We have lots of other options to invest. Rising interest rates means lots of European financials are headed in the other direction. Why go for something that is burning capital when the rest of the sector is now generating it. Tom, to David's point, he's dead on. Year to date, in fact, over the last 12 months off the summer lows, European banks have absolutely ripped. And it's not just the Eurozone names. Even UBS year to date is up something like 20%. So if you're sitting there in a dog like Credit Suisse at the moment, you're wondering if you should be somewhere else. And clearly he's made that decision to make a move.
As David knows, I have memories of my Credit Suisses in my mind. You get married to a stock. There's no other polite way to put it. That's what happens. And Mr. Harrow is acclaimed. He's often on the international cycle a top, 90th percentile performer. At the bottom line here is he maybe held it a bit too long.
Just another headline, though, that the Credit Suisse management, Tom, won't want to read this morning. A big investor like Harrow heading to the exit. The stock's down another 2%. And just to see that name, him go through the numbers there, it went from 20 to 60 or 70. Yeah. It's back down to 272 on Credit Suisse, Tom.
You may look at the financials here, and we're going to do that right now with someone hugely qualified. Jan Patrick Barnard is with Bloomberg, and we're hugely advantaged by his experience in the banking industry. Jan, I've got to ask the key question. Is there any evidence that the outflows from, on a broad sense, wealth management, asset management have slowed down? Is there true evidence of that?
And that's the key point that Credit Suisse has to provide. And Harold pointed to that fact that he's worried about the outflows to continue. And if I have to make a bet, I would say they probably will continue over the next couple of quarters. And investors will be very keen to see them to stop, not just like one quarter, but like consecutive quarters in a row to really show that confidence that Credit Suisse has stopped that bleeding. And it's really like making progress on the turnaround, because so far Credit Suisse has done or showed us nothing to believe that, and that's why some investors are leaving, or big investors like Harrow are leaving the ship now.
We had just had, Jan, what we know as a dog and pony with Goldman Sachs, and as a generalization, they looked out 2 years to get to a new profit regime. When Credit Suisse now, in their trauma, does a dog and pony, is there any point of summed profitability?
Well, I mean, certainly the bank has still a solid business model in general. But if you remember, like when we spoke about the Lehman incident like 2 weeks ago, their client base and the business model that Credit Suisse is running after is very much based on the trust issue. And right now, Credit Suisse has done nothing to rebuild this trust either with investors or with their clients. So what they're doing is, like, as Harrow said, they're burning through capital. They're trying to keep the ship afloat. They're still doing the business that is there, but that's not enough for a share price that is so depressed to post some recovery, right? So they have to come up with some solid plan that is believable, that makes sense for investors, where they tell us, like, we are going to do A, B, C, and this is how we turn the ship around. And so far, we have seen 2 re-ramps, big announcements, lots of tra-ra, but very little substance. So that's lagging, and that needs to change.
Harris Associates used to be one of the biggest investors in Credit Suisse. It has succumbed to the Saudi National Bank in terms of leadership, or it did last year. Now we've got Qatar also at the top of the list for investors. How does the nature of different investors change the nature of the direction for Credit Suisse's management?
And that's certainly also a point, that you now have 2 investors from the same region on board there, and they maybe have different plans for the bank going forwards. For them, maybe it's not only a money investment. Of course, at some point it has to make money, but I guess like investors from the Middle East are also like keen to use that kind of bank for doing their business in Europe and in other areas of the planet. And I mean, let's be fair, Credit Suisse still is a good name out there, and maybe like if they really want to, and if they are willing, like, to even like put more money in there, as we heard the bank is burning through capital, so at some point maybe they need more. If those investors are willing to provide that and provide the backing to the bank, maybe that can be a lifeline or some kind of a future for Credit Suisse.
Based on the profile of the investors who we are aware of now dominate, and based on what we've heard so far from management, do we have a clearer picture of what this management plans to do for its turnaround?
Well, I would say no, and that's my biggest issue with the stock. Even if it's very, very cheap on paper right now, trading on 0.2 price to book value, which is insane for a bank, and especially in this interest rate environment. But as I said, like the story, Credit Suisse has outlined some kind of a turnaround plan, but it's just lagging the details and the results, to be honest, right? And that's a big issue. So they need to deliver that first. And if we see, like, let's say, 2 or 3 quarters of really like outflow stopping, more positive sentiment towards the stock, then I would say like we can look further into the future and see how the bank can recover.
Jan, if you look at the chart back to 2009, it's upside down. It's upside down. I mean, how many names can you pick that didn't bottom in 2009 but actually topped in 2009? What kind of stock topped in 2009? And that's the chart at Credit Suisse. And Jan Patrick, the reason I bring up that chart is because surely that chart questions just the viability of the whole business model over at Credit Suisse.
Yeah, absolutely. And if you want to look at the better way to do it, you can look at UBS, for example, where they much earlier like made a clear cut and set a clear focus area of what they want to do. And Credit Suisse was always lagging that. It was always like, let's do a little bit of wealth management. Let's do also the investment banking. There was never this clear commitment to wealth management only. And we built everything around this. And that's what the stock is lagging. And I also got to say, I mean, like with a hero now leaving, it's amazing. You have an investor who stood with you through the financial crisis and says now he's leaving. I mean, that says a lot about stock market performance. It's insane.
It's just been that stock has just been so difficult. Jan Patrick, thank you, sir.
Absolutely.
Jan Patrick Barnett of Bloomberg, thank you very much. Tom, that chart's just phenomenal. How many charts look like that?
Well, we have to be careful what we say.
The top in 2009.
Oh, no, there's no other chart like it. I was just looking at the relative value function. And there's all sorts of tea leaves of compare and contrast here. But this is the spirit of it. There's a thing called institutional ownership, which is a percent of your stock owned by the big fancy people, the smart guys in the room. Goldman Sachs, 80% of their shares, John, are held by fancy people, institutional owners. Supposedly, Credit Suisse is 56%. You wonder where that'll be in the next report. But it is truly unloved out there right now.
And that's been a problem with all of Europe's banks. They look like some version of that chart. European banks do. The difference is what's happened in the last year or so, where European banks have really started to pick up with this rate hiking cycle, with this relief that Europe's not falling apart year to date, and Credit Suisse hasn't participated. And I think that's the big difference for David Herro. European banks for a decade have been dogs, and now they're not, but Credit Suisse still is. Yeah. And that's when decision time really gets that little bit bigger.
I don't have the data in front of me, but Credit Suisse's price to book is under 0.2. BNP Paribas, which is the retail giant of France, best lunch in New York, is at 0.7. And JP Morgan is well above 1, or Bank of America and the others. I mean, there's still a valuation gap there.
Is it a trap?
Well, I said that earlier today. Leibniz almost stood up and walked out. This is really important. I would predict, folks, in the next 90 days, you're going to see this concept of value trap among people. And one of the reasons you get out of a value trap is you own growth. Can you own growth here? Is the other key question.
There's also this question of you complain about something. We've talked about this before. You complain about something for a decade about negative yields and how that's destroying your entire business model. And then all of a sudden you get rates at a level where you could potentially survive. Can you capitalize on that? Are there the people who want to borrow from you or who want to really create that dynamic to make it valuable, especially if that effectively curtails growth in the region?
Well, from a stock price perspective, exclusively, the rest of the industry is. It's rallying. Just accept this stock.
Which is the reason why David Herro said, I understand the story for European banks because of the rising rate environment. Why should I avoid some of the ones that are going to benefit more than Credit Suisse, which is dealing with some existential questions?
That stock is down by a little more than 2%, 272. Difficult time for leadership at Credit Suisse. Difficult time for a lot of people we know at the bank as well. Just some phenomenal talent there. It just feels like a repeat of what happened with Deutsche Bank, Tom, several years ago.
Yeah.
With its differences, of course, but how do you keep on to some fantastic people that work at your bank when times are this tough?
I mean, our colleague Paul Sweeney lived this with his work at Credit Suisse, where he was definitive in media. John, I would suggest they move on to other places, and card-carrying member of that is Dominic Constant, who won the high ground for Neil Sauce at Credit Suisse, whose shingles out at Mizuho right now.
Very cool. Futures unchanged on the S&P 500. Big week ahead. We'll tell you that a few more times over the next couple of days. Chairman Powell tomorrow and on Wednesday. Payrolls on Friday.
I think the role of abundant liquidity is still critical in this market setup.
Don't necessarily be worried about liquidity conditions in the near term. There's plenty of excess reserves around in the system.
We're seeing the consumers' last stand, if you will, as households are drawing down the very last of savings. They're ramping up credit card debt.
My view is that we're going to see a slowdown in the U.S. economy in the next few months, and it will be significant.
The European economy is looking set to actually outperform the US this year and next year for the first time in many, many, many years.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. We adjust, you adjust. We'll adjust with Jim Bianco here in a moment. John, we adjust with a 3-month LIBOR back to 07, 5%. That is a major, major fact.
2-10 spread, Tom, negative 92 basis points. There's bond
93
market
now.
adjusters as well. If you're looking at the 10-year, we're down about 5 basis points on a session, 3.90, 3.4% last week. Just a massive week ahead of us. Chairman Powell speaks tomorrow. He's got to look ahead to payrolls on Friday, CPI next week, and come up with some kind of message to respond to the robust data we've had over the last month or so.
He's got to speak to Congress, and particularly to the House of Representatives, to the two parts of America. There is an America flat on its back of inflation. Yeah, I guess we're fully employed, but there's a huge hunk of people out there going, really, are we? With part-time work up. So he's got to handle this politically, and he's not going to talk about the elites, what they're doing at stores, all this travel malarkey we're talking about. He's got to address people struggling.
So let's talk about the Senate Banking Committee and a couple of Democrats on that committee. That's where the pushback might be. You know, unemployment's at, 3.4%? Really, really low, and this chairman has been upfront about causing some pain. Now, his argument is if you don't address inflation, it means even greater pain. But ultimately, Tom, will he destroy what's happening in this labour market, and is that the pushback you're going to see from the Democrats?
I would suggest it's the walkthrough going from ultra accommodative to some form of the phrase that's out there is super restrictive. And I would suggest in the last 2 weeks, the dialogue on super restrictive has massively changed. I mean, Alarian, I thought, had a very nice summation of this in the last couple of days.
We can't base it on a single month's data, but if you look at unemployment at 3.4%, payrolls at 517, retail sales at 3%, claims sub 200K, the ISM where that is right now. Can you make the argument with sufficiently restrictive?
No.
With 1 month's data, clearly not. The fact is, though, they're not just going to look at 1 month's piece of data. And a worry that I would have for Chairman Powell tomorrow, and for once actually have a little bit of sympathy for the leadership of the Federal Reserve. How can you commit to a view at the next meeting when payrolls on Friday and CPI next week could completely change the story again? You have to remember, we had 2 years in 2 months. 2 years worth of narratives in 2 months year to date, and that could change again on Friday.
You know, Lisa, I would suggest that the financialization of the system, which is what we spend all our time on, and that is secondary in this testimony. It ends up being 900,000 jobs over the last 90 days formed, 330,000 is an average non-farm payrolls, and yet there's a lot of angst out there.
Well, this has been the line from the Federal Reserve that if you don't have stable, if you don't have price stability, you can't have a healthy labor market. So they'll talk about how they want to weaken the economy, and they're not going to say that means that we want jobs to be cut, right? This has been sort of the very difficult moment. I want to hear the balance of risks. I want him to understand and really put forward his new understanding of the balance of risks of inflation versus the prospect for a fully employed America.
I'm going to balance the risks. The 2s, 10s. John pushed it out ever wider. I'm going to go to 3 digits, John. Negative 93.496. That's out to new wide inversion. The 2s dramatically higher than the 10-year yield.
Driven by the long end, though. Bigger rally at the long end today. So this is the 10-year yield falling faster than the front end. So we're down 5 basis points there, 390.49. Debate on the front end is whether we get another big rate hike from the Federal Reserve. Maybe they go 50. Conversation off that.
Really?
Jason Furman in the Journal.
The conversation's there? Yes.
I don't think the FOMC's there yet. I think they want to wait to see if payrolls confirms on Friday. I think it's 25 basis points. That makes sense. The closer you get to where you think terminal is, you want to move slower. Again,
Furman
that makes
made
sense.
A splash.
Furman in the Wall Street Journal says, if your reaction function is what you tell us it is, you should be talking about 50. That's the conversation from him.
Do you think he had his students write that at EC10 at Harvard?
Possibly.
It was probably a project. I got to write a column for the Wall Street Journal. Why don't you guys write it for me?
ChatGPT.
ChatGPT.
Is that Furman's ChatGPT?
That's 100%.
Just crowdsourced.
Jason Furman in EC10. Now, on the monetarism that we're studying right now, ChatGPT. That's it. He was there. John, what else in the data?
Futures just budging a little bit higher, Tom, but not by much. It's pretty much unchanged on the S&P 500.
We'll give you the data for the week with leadership from Michael McKee. Right now, leadership from James Bianco. Jim Bianco's founder and president of Bianco Research. Jim, I'm thrilled to have you on here on a hallmark day of 3-month LIBOR at 5%. What does that signal to you?
That short rates are going to keep going higher, that the Fed at a minimum is going to be higher for longer. And the aggressive call right now is that they're going to move maybe 75 or another 100 basis points, and we could be talking about a 6 handle before the end of the year on the funds rate. But short rates are going to keep going up, and that, I think, is the big driver of why the yield curve has become a new record inversion, because it's all been driven by the long end. When the 10-year rallies, we get record inversions. When the 10-year rises in yields, we get some flattening of the yield curve, or maybe less inversion of the yield curve. And I think that story is going to continue with the bond market.
Jim, do you expect Chairman Powell will be reluctant to lean into that argument, given we're still waiting for payrolls Friday and CPI next week?
No, I don't think he will. I think that, the data, you're right. I heard you before saying, it's just 1 month of data and it's all been very, very strong. But the arc of data that we've seen over the last several months has not been weak. It has not been what Elizabeth Warren, a senator from Massachusetts, has been calling, millions of people losing their jobs. It hasn't happened. Maybe it does, but it hasn't happened yet. And a lot of people thought it would have happened by now. So I think he's probably going to stay with the more aggressive move that the Fed is going to continue to go at least 2 or 3 more rate hikes. And if you're right, if the payroll data is strong or if the CPI data is strong, that we'll be talking about 50 for the March meeting. Right now, the market's putting about a 30% chance that the Fed will go 50 basis points at the March meeting. It wouldn't take much to push that over 50% and get people talking about it with a strong payroll number or CPI next week.
And the potential for short-term rates to go even higher is the reason why we've been talking all morning about this inversion, this yield curve inversion, the 210 spread, the most inverted going back to 1981. Some people are dismissing this and saying, you can't read too much into it. Other people are saying historically it has been one of the best indicators of recession to come. What is the correct read on this, Jim?
That a yield curve inversion is a forward indicator of recession, but more inversion does not mean a faster or harder recession than less inversion. It's a binary thing. Once you go inverted, you should be looking for a recession. Now, the thing about the yield curve is it can lead as much as 18 months before you eventually have that recession. That would put you in the first or second quarter of next year. And I think that the whole narrative around the recession, that a lot of people don't have that kind of patience. They think that the slowdown is going to happen in the next couple of months, as opposed to an early 24 story. So yes, the yield curve is a very powerful signal that we might be seeing a very big slowdown in the economy, but just because it's inverting more does not mean it's going to be worse, and it could still be up to a year away.
Do you think that based on that and based on the readjustment that we've seen in markets for the past 4 months, do you think that there is a position that seems obviously crowded amid all of this uncertainty?
Oh, that's a good one right now. I think that if there isn't a position that is very crowded in the bond market, it's definitely, higher short rates, that you've seen a lot of speculative positions and a lot of people lining up to basically make a bet that short-term interest rates, the 2-year note, the LIBOR, the Fed funds rate or whatever is going to continue to go higher. Now, the thing about those kind of overcrowded trades is those are less market-driven and more Federal Reserve policy-driven type of trades, so they can be right at times. Other than that, if you want to look for crowded trades, I'd have to, meander outside of interest rates and maybe say the reopening in China is probably on my radar as being the biggest crowded trade that we're seeing right now. Everybody's in on that trade, and with the idea that they're only pushing 5% growth for this year was a bit of a disappointment for that trade.
Jim, are you suggesting we may have seen the reopening trade play out already?
Yeah, I think so. I mean, reopening, yes, the economy is going to reopen. It's going to be stronger than it was. But this whole idea that it's going to be rip-roaring in China, that they are going to produce a ton of stuff, put it on cargo ships, send it to the U.S., and collapse goods inflation in the U.S., I think that trade is a little bit overdone right now, and there's really no evidence that any of that is going to come to pass.
Jim, wonderful to catch up with you, to get your thoughts. As always, looking forward to hearing more from you through the week as we anticipate payrolls on Friday, Chairman Powell tomorrow in front of the Senate, in front of the House on Wednesday. We often tee these things up to be big deals, Lisa, and then the individual lawmakers just try and make YouTube videos and clips to send around to their constituencies and don't ask the questions maybe Wall Street wants to hear.
So I started to look into when the last time that we got one of these hearings that was actually helpful or newsworthy.
How far back did you go?
And then I was just like, I can't do this anymore. I mean, honestly, they're never that telling, especially if they're going to go after their political message and you're not going to get the sort of real hard-hitting questions about what their direction and what their time frame and thinking is around monetary policy. So I don't know, maybe he can get away with just saying, you know, whatever you want.
It used to be that there were rules of the road. Chairman Greenspan never spoke about the U.S. dollar. That was the purview of the Treasury Department. All that was blown up, granted, for once-in-a-lifetime events. And they've got to start getting back to, I really shouldn't comment on that, blah, blah, blah. Are we going to see it? I don't think so.
I don't know how you put it back in the box, Tom.
After back in the bottle, yeah.
The demands of this central bank just went sky high. And with it, they had to introduce radical transparency. And I just don't know how you put the paste back in the tube.
Radical transparency. Let's go to it right now. John, the Formula One interview we did, Christian, what was his name?
Come on.
Horner.
You've got it.
Netflix star. Nailed it. People just ignored you. You spent all weekends preparing for this. I tried to ask one intelligent question. Bramo crushed it. That's the response on Twitter.
What are you talking about? Like, genuinely, what are you talking about?
Out on Twitter, she and the Bramo offspring all weekend. F1,
Netflix,
ESPN,
Netflix or
they watched
ESPN?
Like three seasons.
Netflix, 100% the Kardashian, the Kardashian of driving. I did watch it.
Red Bull domination. Just remarkable.
Domination. I'd never seen this, John. The leader, Verstappen, was barely on camera.
It's just gone.
They just don't even. He's just like out front.
The interesting stuff was Fernando dropping back and making his way back through the field again. But
I watched the kid from Thailand, Albon.
Yeah.
He started out like at the back and he went up like 10 levels, which I thought was. I wish they'd shown that more.
You're enjoying this, aren't you?
I'm really enjoying it. And what's fascinating, he alluded to it, Horner, the tracks are really important. Like they were all complaining Bahrain is really not that good a track.
High temperature. We'll see if he can dominate on other tracks, which essentially is what he was alluding to. Futures right now,
I don't know.
positive 1/10 of 1%. I'm pleased we're doing this season. This is Bloomberg.
Yeah.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. U.S. lawmakers are stepping up the push to ban TikTok. Senate Intelligence Committee Chairman Mark Warner plans to introduce a bill this week to allow the U.S. to systematically ban Chinese technology, including ByteDance's popular video service. One of the concerns is that TikTok gives China access to Americans' data. This week on Capitol Hill, Federal Reserve Chair Jerome Powell is expected to lay the groundwork for higher interest rates. Powell testifies before a Senate committee on Tuesday and a House panel on Wednesday. Fed officials are looking at raising rates several more times. That's a prospect that's making Democratic lawmakers uneasy. A second Norfolk Southern train derailment in Ohio has Congress calling for rail safety legislation. Saturday's derailment happened outside of Springfield, Ohio. That's about 180 miles west of East Palestine, where a derailment spilled toxic chemicals last month. The CEO of Norfolk Southern will be questioned Thursday when he testifies before a Senate committee. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We benefit somewhat indirectly from China because, unfortunately, the UK does not export anything like as much to China as, say, the Germans do. So in Germany, it's big news because of the exports of cars and heavy equipment. For us, it's more indirect because our actual direct trade volumes are relatively modest. So it's not great news, but I don't think we'd been expecting much more, frankly. And 5% that's actually delivered would be better than a sort of bogus 8.
So Howard Davis, NatWest chairman, can I pick up on that last line? Bogus 8. I've had a message already this morning. They say it's 5. Can you believe the data that comes out of the country? Anyway, there is still that skepticism, that doubt around Chinese economic data, Lisa. It's not going away. And I would add an additional point into this as well. And we've heard this from Bill Lee, the Milken Institute. It's not just the data that you receive out of that economy. It's how certain banks cover that incoming information as well. Are you truly getting their view on things, or is that the more PR type palatable view in the mainland to make sure they can maintain a presence?
Two questions. Are they trying to generate some credibility in their numbers? Or are they basically signaling that they want to de-emphasize the economy over some of the other goals? Those are some of the two questions with bringing the growth target to 5% rather than the expected 5.5%.
Is that another way of saying this might not be the end of the regulatory volatility of the last couple of years?
We've already seen it being ratcheted up from China. We've seen them go after data with a new data group, a data analysis group, basically to govern how different companies use data in China. That is really going to be one of the big questions, especially with what Xi Jinping has signaled over the past couple of months.
I like what Leland Miller said a couple of weeks ago, too, his China Beige book, where he said, look, it takes a while just to ramp up. It's much more structured in terms of the ramp up of the linkage of product and consumer. Citigroup wrote a wonderful note last week about this, as they get to 5%. It's not the cacophony that we have here, the microcosm that we have. It's much more structured and predictable, and from that is how you get to 5%.
I have to say, a legit 5 off a higher base is a tremendous figure out of China. This is the reopening story, though, so it's pretty mechanical. You go from shutdown to reopen, you should get that pop. It's the growth story of next year and the one after that people are struggling with, Tom. If you look at the consensus, it goes from 5 handle to 3, and it's that shift to 3 that you start thinking about pretty quickly, Tom, towards year end.
We'll have to see. Right now, on oil and what it will do with 5% Chinese GDP, her book is definitive, and we have her on because the book is Saudi Inc. Ellen Wald is definitive. It's senior fellow at the Atlantic Council. And what's so important about Saudi Inc. is she and we're going to Jeddah next week. John Farrow leading our charge. It is a walled and team surveillance move to the Saudi Arabian Grand Prix as well. Ellen, I think our stereotypes of Saudi Arabia are ridiculous. I'm as guilty of this as anyone. From Riyadh to Jeddah, and the commercialism, the capitalism of the nation. How vibrant is Saudi Arabia right now?
I definitely think it's more vibrant than it has ever been. My idea of Jeddah is I think about it, and you've got these, the old porches in the old town, and I think about it, from the, basically like never changed since the 1800s. But they're having a Formula One race there next week.
Oh, they are. I didn't know that. Oh, interesting, John. Let's look into that.
That's
right
a great
now.
Coincidence, isn't it?
Martin,
that we go in 2 weeks the same time.
And we have Ellen on at the same time to help us get to Jeddah as well. Ellen Wald, let's get serious here on China and 5%. Will that drive oil up $10 a barrel?
It could. I think what we're seeing with China is that consumer demand is returning, industrial demand is not returning as quickly, and so we're still in this kind of slower climb up. I remember when they started the reopening and everyone was anticipating this huge surge in oil demand. And I said, well, I don't know if it's going to happen quite as fast as we saw in the Western economies. I think it's going to be more of a slow climb up. And the question is really, when is that going to start hitting? And it does seem like now the consensus is not till H2, and that's when we're going to see $100 oil potentially. Of course, that hits right in the middle of the summer and potentially very high temperatures and lots of driving demand, especially in the U.S. So I do think that that's really more of where we're looking at in terms of a surge in oil prices. And of course, everyone who's predicted high oil prices, we've seen oil jump up and then go back down on recessionary fears. So I do think we're headed more in an upward trend, but there's always that potential for things to kind of wobble.
One of the most notable sort of trends over the past couple of months, Ellen, is the number of people who have just abandoned calls for $100 oil and saying, actually, you know what, it's never going to come back. This is basically where we're going to stay. I mean, it feels like the market's a bit of a, I don't know, a child who's basically all or nothing sometimes, at least for the past couple of months. Do you get the sense that that is becoming one of the main themes, the dominant themes that you keep hearing from the people you talk with?
Yeah, I do think that we are seeing, on the whole, people kind of walking back their predictions. I remember at the end of 2022, we kept seeing, these incredible predictions. Oil is going to be 120, 130 in 2023, and now we're seeing revisions down to, well, maybe we might hit $100 a barrel. I do think that we are headed in general towards a period of tightness, of a supply being more of a concern. I do think that there is potential in certain areas to increase supply to meet that demand. That the place is not necessarily the United States, though. I don't think we can depend on U.S. producers to ramp up production as much as we have in the past, and that is something that is not necessarily being reflected in the forecasts we're seeing from, say, the EIA. I do think Saudi Arabia and UAE have potential. There's also potential from Iraq, and I do think that if things get really tight, we will see OPEC moving to increase their quotas, but maybe not really until June, July, or even August.
Some people say that stockpiles have gone up and that the price has remained relatively low relative to expectations because of the increase in electric vehicle usage. Do you buy into this idea?
No. I do not.
Okay.
I think definitely we're seeing more people buy electric vehicles, but I don't think that these are that these are a main driver in stockpiles, because electric vehicles are still limited in their range. And when you look at big driving, I mean, it's not people driving an electric vehicle, 20 miles to, do some errands around town. So I really don't think we're seeing that bite. I think, if you really want to look at the big drivers in demand, we're talking about China and India. And these are not places where electric vehicles are necessarily having a huge impact. I know it looks like a big increase because when you're starting from very little and you get an increase, it's very big. But, for every EV that's sold, how many, internal combustion engine cars are still on the road and still being driven. So I don't think that is cutting demand in the places where demand is really increasing all that much. I do think that they are definitely growing in interest, but I think that there is a limit to how beneficial they are given how range bound a lot of these vehicles are.
Looking forward to Jeddah with you. Alan Wald, the brilliant Alan Wald of the Atlantic Council. Thank you. 2 weeks away, the next Grand Prix. Full F1 coverage coming up through the year. Looking forward to
Max Verstappen said this will be a different race. He made very clear in the last hour or two of the follow-up to Bahrain that it will be much closer at Saudi Arabia.
Christian Horner suggested the same thing.
Yeah.
It would be problematic, I think, for us neutrals or us Ferrari fans if it was
I found
more the same.
I feel like Ferrari is like the Yankees of Formula One because it's just like they always win. And so it's sort of like, just rooting for the winners.
They haven't won a championship for a long time.
Oh, but they always, it's like one or two. It's
no,
like
a long time.
Were you as guilty as I was? Were you
driving
watching?
championship? I think Kimi Räikkönen back in maybe 07, 08, something like
They're
that.
always up there. It's like the mid-pack.
Were you like me yesterday watching
Ferrari, the Kardashians?
What?
The Ferrari, the Kardashians of Formula One.
That's right.
God, that hurts, Bramo.
Were
that
you?
was Christian Horner, not me.
Thought
That
we
was
were
what he
mates.
said. Well, come on. They're
he said
beautiful.
he said it was
They're flashy.
Kardashian on wheels. I'm not sure he was describing Ferrari. He was describing Formula One. Okay, Dan Suzuki, Richard Bernstein of
John's
Pfizer, Eric Knudsen of Neuberger Berman, all coming up. Looking forward to that. Good stuff. Thanks, guys. Happy Monday.
Bloomberg Surveillance, good morning, everyone. The beginning of an extraordinary week. I'm going to say flat out an extraordinary 10 days to launch out to that inflation report. So critical to Chairman Powell as he speaks on the Hill this week. Lisa Abramowicz and Tom Keene. John Ferro in preparation for the next meeting. I think he's on the phone with Ferrari.
Right being like, I'm so sorry. I don't know why she said that. Do not like the Yankees at all, I promise.
Is that her fault? We're having a lot of fun with Formula One. And, of course, there's the Formula One of the stock market, where I'm sorry, to me, the highlight here, Lisa, as we go to Gina, is the VIX 18.96. The Gloom crew just doesn't believe it. There it is. Wow.
The highlight for me was actually something that Lori Calvasina wrote in her notes, where she basically said that markets are becoming a lot less correlated, that within the indexes, you're not seeing the same kind of correlation. Individual stocks are breaking away, and you're seeing this with the flows, too. Flows are now going more into individual stocks, and they're coming out of the indexes. So are we entering kind of a new era with the discipline foisted upon the markets of money costing something? To me, that's fascinating.
The foundation to me is money's costing something, that the gravity's back in the market, in charge of gravity for the equity space. At Bloomberg Intelligence, it's Gina Martin Adams, and joins us here after a weekend of really thinking about the markets forward. Gina, you've got a portfolio which is based on some really good quantitative, I'm going to call it black box math, over to fundamental research on value. How's your portfolio doing in this shock rally in equities?
Well, look, it's been a really interesting ride so far in 2023. Obviously, January value was not even part of the story. This sort of momentum crash that we experienced with a rip in the non-profitable stocks certainly hurt any value-oriented investor. It wasn't anything to do with profitability and value, which are certainly key characteristics. But February's correction was really interesting because we did start to see some rationality return to markets. I only say some, though, because we still saw tech leading the recovery, and tech certainly doesn't qualify for us on a value screen. I think March will be really interesting as well, because March could be that sort of catch-all month where we really sort of right-size our expectations for Fed policy. We get a better view of what's happening with employment conditions, which have obviously whipsawed market expectations here, and we get some more rationality kind of emerge over the course of the month.
Gina, I just noticed 2-10 spread going down to new record wides, 93.4 basis points, make that 93.5 basis points of curve inversion. I've got IRA Jersey space, 3-month LIBOR at 5%. I know you and IRA aren't on speaking terms, but what does it mean to your world when LIBOR hits 5%? 3-month LIBOR hits that important mark.
What it means most essentially, Tom, is that valuation expansion is limited in the equity market. When in our broader fair value model for the S&P 500, it's really difficult for us to get to a justified multiple above 17 times earnings when we're looking at LIBOR at such extreme highs compared to recent past. So it means a lot for the equity market. It also means a lot for the equity market in a relative sense. Obviously, cash is worth a whole lot more today when you're looking at LIBOR at 5% than it was a few years ago. When we were paying nothing for cash, naturally, cash was forced into some risk-seeking behaviors, and we saw that manifest itself in enormous valuation expansion for the index. Now we're seeing the opposite occur. We characterize this as terror. There are now reasonable alternatives to stocks. Across the landscape, stocks benefited from there is no reasonable alternative for more than a decade. Now there are reasonable alternatives out there, and the result is we think your long-term return expectations for the equity market have to right-size. Our long-term fair value model says large-cap stocks should be anticipated to return something like 6% average annual returns for the S&P 500 anyway, versus the 11% average annualized return we had in the post-Great Financial Crisis era.
Which is something that a lot of people have trouble wrapping their heads around. And I want to talk about the psychology of having money cost something, and suddenly everyone who used to be a macro trader, regardless of whether they were picking stocks, have to become fundamental investors. How much are people aware of just the fact that we're not going to get necessarily a flip-flop narrative, that it's going to be perhaps this company is going to do well, this company is going to be bad, you've got to kind of figure it out?
I think investors are starting to come to terms with that, Lisa, but I wouldn't say that we're fully there, and expectations have completely normalized to this new era. Certainly, we learned a lot in 2022, but 2022 is also not necessarily representative of what to expect going forward. Correlations in the equity market spiked in 2022 because of the risk-off scenario. Now they're coming back down, but investors generally have become accustomed to this idea of if you put money into an index fund, if you put money into any form of broad equity market exposure, you're generally going to do well. To the degree that that sort of thesis was driven by very, very low interest rates, that starts to go away in an environment where interest rates are a lot higher, and suddenly idiosyncratic risks matter a whole lot more in the equity market. You probably have different segments of the equity market performing much better than others. Inflation is extremely meaningful in this climate. It didn't mean anything in the 10 years following the great financial crisis because we didn't have to contend with really any inflationary spiral or spike at all. So the investing climate has changed. I think 2022 sort of introduced us to that, but wasn't necessarily the perfect example of what to expect going forward. And that's where the risks come in, because investors can't rely on 2022 necessarily as the model. What does the model look like? And I think that our most recent example of what that model may look like is actually all the way back to 2003 to 2007, in which inflation became a general driver of stocks. The market traded with very extreme winners and very extreme losers. Dispersion was a big part of the story. Active managers generally started to do a little bit better, and value led. So you have to go back quite a ways in history to get a representative example of what to expect going forward, and that is still a challenge.
Will big tech still have a role in these indexes? I mean, how much will their role really shrink in an era characterized by money costing something?
Yeah, I think that their role has shrunk and will continue to shrink to some degree, particularly because their earnings growth outlook has been shrinking. And as long as their earnings growth outlook is less so or less strong than the broader indices, it's really difficult for tech to perform well. This is a growth-oriented sector. They've got to see that growth outlook really power returns going forward, irrespective of the economic climate, and they're not seeing it right now. This is kind of, I think, the underappreciated story of tech is, yes, interest rates play a big role, but arguably what may have played a bigger role in 2022 was the fact that earnings started to fall short relative to the rest of the market. These sort of long-term stories that really powered the optimism in tech started to get dismantled. And tech needs that story, needs that earnings growth input in order to perform well.
Gina, let's talk use of cash, but not use of cash of corporations that you follow at Bloomberg Intelligence. Use of all the cash that is out there. Do we underplay the amount of cash that could go into equities worldwide because there's no other place to go?
Really interestingly, I don't think there's no other place to go, Tom, because we do think there are reasonable alternatives, and cash is now much more appealing than it used to be. That said, we do see U.S. households in particular holding an enormous amount of cash, of their assets in cash relative to recent past, and cash holdings are still rising, quite contrary to some of the popular beliefs out there. Consumers are relying more on their credit cards to fuel spending in the U.S., but they also hold a lot of cash. What typically fuels consumer investment in the equity market is actually their general optimistic sentiment about the economy. And we've naturally seen consumer sentiment depleted in an environment where inflation was so rapid, so profound. We're starting to see consumer sentiment come back. Over the course of this year, consumers are going to have to contend with what we think is likely a rising unemployment rate, even though the inflation scenario is more minimal relative to the year just past. How does that play out in consumer sentiment probably will be incredibly important to determining whether or not the consumer comes back to equities and starts to reallocate into the risky asset class.
Gina Martin Adams, thank you for the equity brief this morning before all this economic data. Martin Adams lifting the stock market with her conversation. Read on the screen earlier and right now a constructive tone. Futures up 10. Dow futures up 37. And the NASDAQ up 0.4%. I mean, there it is, 3 days in a row, just... there's a bid. I think that's what the pros say.
People want to see this market rally. It seems like there's a bit of a lift going forward. And how much is this what we heard from David Leibovitz of J.P. Morgan, where he said, it's not terrible, it's not fantastic, it's not going to be the bottom that we haven't seen before. We might go back to October, but there still is enough with the earnings and companies that can muddle through with higher inflation and higher rates. And I think that that's sort of what keeps getting sussed out on the buy side.
It is March. there was February, and I believe in February bonuses were paid. Here from Sri Natarajan at Goldman, he's among a group of top producers at Goldman whose pay has rivaled the more than $75 million awarded to Chief Executive Officer David Solomon. And he exits. This is in program trading and equities as well. A guy who's been there a long time, Joe Montesano. It's collegial, quote, he's stepping down to take a break. That sounds like what you said Friday. You know,
I'm taking a break.
I'm taking a break,
yeah,
at least for 2 days. But there it is. He's stepping down.
Yeah. I mean, look, we don't know what happened, right? He has yet to line up another job, according to Sridhar Natarajan's reporting. There has been a real desire for talent, right? The top talent is still very much bid. And we were talking about Credit Suisse and Credit Suisse First Boston. The spinoff in the U.S. is granting partner-like status, sort of like the Goldman Sachs model, to some of the people who are going to stay. So the key to incentivize the top earners, the top producers to stay clearly is in the forefront. I don't know. We'll find out what exactly happened here, or maybe we won't, but it really does highlight how much people are getting paid who are the producers.
That's the same old story. Now I'll take it over even to Asia as well, where things get tough and people pull away, and they pull away from Asia. We're leaving Asia, and then 6 months later, oh, surprise, we're back in Asia. I mean, this happens.
Yeah, well, there was another story that caught my attention this morning. Did you see that banks are starting to offer, more than 20 banks have offered 5% CD or 4% CD. But this is what's happening, that finally certain banks, aside from the very big ones, are starting to pay up just a little bit.
End of an era right now. We're going to leave you with this as we go to a busy day with Bloomberg, with futures up 11. And all I can say is it's extraordinary. Very quickly here, Gary Rossington has died. If you do not know who that is, he is the last of Leonard Skinner. I can't convey how Southern rock changed the world years ago, of Allman Brothers, of Leonard Skinner. This is the guy, folks, who wrote Sweet Home Alabama with Atlanta Rhythm Section. They owned the major scale. They brought the major scale back to music, and they never got credit for it. Mr. Rossington, a wonderful guitar player. Stay with us, Michelle Girard, next. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Norfolk Southern has unveiled a new safety plan following a derailment last month in Ohio that spilled toxic chemicals. It will install more trackside heat detectors and explore the use of newer types of sensors to uncover axle problems. Norfolk Southern had another derailment in Ohio over the weekend. This one didn't involve hazardous materials. Ukraine says that Russian forces are trying to cut off the besieged city of Bakhmut. The Russian attack is preventing Ukrainian troops from reaching residents who want to evacuate. Still, analysts at the U.S.-based Institute for the Study of War say Russians will probably not be able to encircle Bakhmut anytime soon. For the second time this year, Tesla is cutting prices. The electric car maker is reducing the base price for its Model X by $10,000 to just under $100,000. The Model S will be cut by $5,000 to just under $90,000. In January, Tesla slashed prices up to 20% to boost sales. And cue the Tom Keene sound effects. Yes, the new Formula One racing season began over the weekend in Bahrain. Red Bull's Max Verstappen began his defense of back-to-back titles by winning the race. Formula One has become a sensation in the U.S., thanks in part to the Netflix series Drive to Survive. We spoke with Red Bull team principal Chris Horner.
We've seen massive growth. I think that the whole phenomenon through Drive to Survive has just introduced Formula One to a whole new audience, a younger audience, and very much an American audience. So I think out of the 25 new partners that we've introduced in the last 3 years, 21 of them are US based, and 3 of them are in the Fortune 500. It's just, Formula One is on fire at the moment.
The U.S. will host 3 Formula One races this year. I'm Lisa Mateo. This is Bloomberg.
There is very much a recalibration that would go on, tightening conditions, and you might actually see some breakage at that point in time. But I also think that what you're hearing clearly from the Fed is a process which is going to be a digestive situation where they're going to digest the data. And the market has rationalized over the past few weeks, not necessarily that there's a lot of more rate hikes to come, but there's less cuts to come.
Jerome Schneider on fire. A lengthy conversation with Mr. Schneider of the short-term market for PIMCO. Really quite valuable last week. Just a great set of conversations last week. Mental block. I'm so sorry. Right now, there was a couple guys that were just on fire last week.
Yeah, trying to understand where we are and how far we could potentially go. This feeling that 6% now is the bogey that some people are talking about, whether we could potentially get there and what that would mean. We had a number of people saying that was likely. Pork Garvey was terrific, yeah.
With Jerome Schneider. I thought they just really had Pork Garvey with ING. Well, we staggered this week, and Lisa, you've lifted the market up, with your smart questions to Mr. Horner. Futures up 13. It just won't go down.
You said that Gina Martin Adams was the reason for the market to lift, so now it's me?
That's you, yeah. I got a corrective call here from Bloomberg Intelligence. I'm sorry. There's a bid to the market, over the last 3-4 days.
How much is this just directly correlated to this feeling that perhaps people got ahead of themselves with their rate hiking expectations? You're seeing it in the 2-year yield. It's come off for a couple of sessions, so it's gone lower from the peak. There isn't the same kind of hysteria about rate hikes to the moon and that perhaps
I agree with that
Fed
strongly.
and this ECB can take a breath and really take a look at the incoming data. And I think that is the feeling that you're seeing percolate into markets today.
The hysteria is not there right now. Let's use that as a segue right now into Michelle Girard, head of U.S. markets at NatWest Markets and wonderful in economics over the years. Michelle, I think that's a really, really important point. Are we getting used to higher interest rates?
Well, I think, though, the point that you both were talking about, which is that the hysteria over how high rates will go has calmed down a bit. And I think that that's right. I think it was very much, I think what's happening rightly in the market is that, as kind of in that intro was noted, it's really not so much that we think the Fed is going to be raising rates so much more than we had anticipated. We ourselves have raised our terminal rate. We do think it's probably closer to 5.75. Wouldn't rule out 6, but it's really more of the market letting go of this idea that the Fed could pivot in the middle of the year and that we'd see rate cuts at some point in the second half of the year. The Fed was pushing back pretty consistently against that idea. The market stubbornly held on to it. But with all of the strength of the data, as we saw, early in the year for January, the market is now finally, most of that has been priced out. But again, I'm not sure that we should be pricing in that we have to go to 6% or more. At least at this point.
On the calendar, we have a couple of key dates coming up, starting with Friday. We get the labor market report. Some people might argue the JOLTS data that we get on Wednesday will be important as well, heading into CPI and a host of other granularities here. What are you watching most closely to understand whether this is just backward looking or whether this is an actual ongoing strength that is continuing?
Well, it certainly will be important to see in the Friday jobs data how much of a payback, so to speak, that we get. That 517,000 job gain in January obviously surprised everyone. There's a lot of debate about how much of that may have been seasonal factors, how much of that may have been due to mild weather. So the data on Friday will help give us a bit of an anchor in terms of what's really real in terms of the health of the labor market. Even with a more moderate gain, we've got an increase of 175,000 forecast. You're still looking at a trend in payroll growth of over 300,000. And as you said, the JOLTS data, the claims numbers, everything does still suggest the labor market is quite healthy, quite tight. And I think that's going to keep the Fed on guard in terms of their expectation that wage inflation can pull back. And I think if you don't have an expectation that wage inflation can moderate, it's hard to feel confident you're going to get inflation all the way back down to the 2% target that you seek.
A number of the guests who we've had on today, including Lori over from RBC Capital Markets, Lori Calvasina, she was saying that even with the potential for higher rates, markets are already pricing a lot of that in, and they're seeing a lot of strength from the increased demand, from the strength in people's wages. Do you agree? Are you leading into risk? Because right now, a lot of these companies and a lot of these consumers are able to handle rates where they are.
Well, I think that that's true in the sense that I think the market is pretty well priced for what I think is appropriate in terms of the interest rate outlook, given what we know now. The economy for sure has shown resilience. I do think that some of this has been, again, this excess savings that have continued to sort of bolster consumer spending, making it easier to sort of tolerate higher interest rates. We've also actually seen, with the strength in the labor market, we've seen real gains in the wages, in terms of wage increases have outpaced inflation over the last few months. So there is support for the consumer. That said, we do think over the second half of this year, you are going to see the consumer pause. We actually still have a recession in our forecast. So I don't think that we've been able to avoid what I think will ultimately be the impact of these higher interest rates from the Fed.
Michelle, you have a wonderful grounding in what I'm going to call freshwater economics and even Midwest economics, if you will. Is the chairman a slave to theories from another time which don't work coming out of a pandemic?
That's a great question, Tom. I don't think that the chairman is a slave, to sort of what always has been. I mean, I think that there are some very fundamental rules which still apply. I mean, I think when you've got healthy demand, an economy that is growing above trend, and you've got inflation higher than you want, it's hard to anticipate that inflation is going to come down. So I think that, kind of operating in the same sort of general way that you've approached, monetary policy for the last 100 years isn't wrong. But I also do think that the chairman and the Fed have been open to recognizing that in the unprecedented events of the pandemic and all that followed, they don't know. And I think that this is why they're trying to sort of feel their way along. They are a bit data dependent. I think they're hesitant to be as forward looking as they might normally be inclined to be, because they acknowledge that there is just so much uncertainty now in terms of being able to really assess if the world is exactly working in the way that it always has.
Michelle Girard, thank you so much. With NatWest Markets, they're a brief here. We've got a couple of these today, folks. Good economic briefs before all of this data. I'm looking at, folks, we have the ECO Go screen. None of this is original. I got nothing original to say. McKee just says, Tom, go ECO Go and you'll pretend you're smart. So we got factory orders today and durable goods and that, Lisa. And we go on, and I don't think we're talking enough about the microdata, not ADP. Nobody has a clue about that. But what do we do with initial jobless claims? We got it wrong last week. Now it's 195, and I'm sorry, it's still fully employed America.
Well, and this is a reason why JOLTS is taking on new importance. Even though a lot of people have said that this is perhaps not a relevant statistic. But even if the companies are posting fewer jobs, that could possibly indicate there is a softening in the hiring, albeit not necessarily the firing, because that would be the unemployment benefits that people would be filing for. I think what Michelle was saying there was really important about the payback from the previous month. Do we see the payback that we didn't see last month? And that sort of revises that 500 level to rethink that perhaps we are seeing some sort of moderation.
Well, do you get the 3-month moving average to go from the survey of 330,000 maybe down under 300,000? That would be a start. How about March 15th, off our radar, the day after CPI, there's a retail sales report. And it's gloomy. I mean, I'm looking. We don't need to go into the numbers now, folks, because they're going to change before we get to the 15th.
100%.
But the answer is, it's a gloomy expectation out there in the market. Futures up 9 keeps saying it's just not that gloomy.
Yeah, well, that's basically what I was going to say, is that they've been gloomy expectations for a while, and every time they've come in gangbusters. I mean, one data point after another. If you look at the Economic Surprise Index, it's the most positive it's been for a long time in the U.S., and you could see this as a trend throughout. So I don't know. I don't know what to make of this, and how do you put this mush together and then still hold true to some sort of theory that you just, they're going to be lag and long
and I know NBER has got a whole series. John Podesta has a whole series of papers on mush over at NBER. And the answer is, out of a pandemic, that's what you have.
How long do we have a mush?
It's probably accurate.
How long do we have to have a mush? I mean,
this
is the question.
Formula One, did we embarrass Ferro?
I don't know. I don't know. He hasn't come back yet, so we'll see whether he comes back tomorrow.
He and Mr. Horner are talking about bars and restaurants in Coventry or something.
Well, we're tourists.
We are tourists.
We're the new upcoming audience.
Don't be a tourist. Stay with us on radio and television today. Mr. Diamond, the 11 o'clock hour.